Good morning, guys. Welcome to Monday, the 23rd of November. We are inching closer to Christmas, as I'm sure you're all aware. And of course, we're here back with your host, me, Greg Secker, in the trading den. And today is going to be this is about 11:15 in the morning. So it's going to be another one of those sessions where I walk you through my ideas for the markets as they're opening up. And I'll be using my favorite software tool of choice, which is Smart Charts, and seeing what that is suggesting ahead of the trading session today. Now, I must start today's session off by saying to you all, thank you so much for the big support that you've been giving me on this channel. I started in January this year, and we are inching closer to 100,000 subscribers. I expect us to be there as we edge into December. So to celebrate that, we're going to be giving some prizes and some gifts away. So please stay peeled for that, my dear channel subscribers, because you've helped us get there. We're also going to be launching something pretty exciting, and I want to get your feedback on it. Many of you have been asking, can I have a live session with you, Greg? So when I do these sessions, we've actually just been implementing some technology so I can zap other traders in, so I can actually do what I'm doing now, but kind of do it in real time to you. If that's something you're interested in, please leave a note in the comment, because it's something we're now looking at launching, which is the ability to actually watch me do my analysis live and in market context. And the reason I like that is so when things are happening live in market context, you can see my thinking and then look at charts and see what I'm doing and why I'm doing it and why I'm thinking the way I'm thinking. I will tell you this, though, it is not going to be a tipping service. That is certainly something I'm absolutely adamantly against. I'm trying to empower the private investor, the individual, you, in making smart decisions based on knowledge, based on strategy, and based on understanding of contextual market conditions. So this is really a live session I'm going to start launching very, very soon. If you're interested, please let me know in the comments. On that, let's get into the session. I know you're going to be watching this later on today, but hopefully soon. This is one of the last times you will have to watch it later on. We're looking at bringing a live service to you so you can actually see me do it as things happen. Okay, let's jump into Smart Charts and see what is happening as we are now bordering the last week of November. We know, of course, it's Thanksgiving this week, so there is some market reaction to that. We also know that all of these nice, very happy news announcements surrounding Moderna, surrounding AstraZeneca, surrounding any of these vaccines has really pushed markets up. Markets are tending at the moment to really favor that positive news and kind of dumb down any of the negative news surrounding further lockdown extensions, for example. We're hearing today off the Prime Minister in Parliament that we will be allowed to see our friends and family at Christmas time. So that's giving markets a little bit of a boost. And you're going to see that as we now jump into the charts. I'm going to start today by looking at a couple of currencies that I am BDI watching right now. So I'm going to start myself off as we now jump into Smart Charts with my dear Aussie friend, the Australian dollar. I'm going to bring the chart nice and big so you can see what's going on here. But really, you should be aware, look, we've done, and I've left some of my scribblings, as I always do. I'm actually going to take all these news announcements off. I don't need to see those right now. So let me just pop them off for a second and go to trading and say, I don't want to see high impact. I don't want to see medium impact. I just want this kind of cleaned up. This was some work I was doing earlier on. For those of you who've just logged into Smart Charts will know that there's been some upgrades on Smart Charts. So for many of you have written in and said, thanks very much for those upgrades, because they just make life a lot easier for us. So let me just show you what I mean by that. My team, fortunately, that watch me and then feed back to the developers of Smart Charts saying, Greg wants this, Greg wants that. Well, things have been going quite nicely, actually, on that front. So there's like nice, cool things like just from here, there's now a ruler I can just grab nice and quickly and easily. I can measure the price from here to here and I can say, okay, that's 300 odd pips. I can then go back to here and just grabbing that tool just gives me a quick little view of how many pips I'm talking about. So that's 110 pips there. And then it pings off. So it just gives me a nice quick read. There's loads of tools in there. And if you haven't seen it, go into the Learn section if you're a Smart Charts user. And the latest updates will be there all the time. This is an addition I wanted. The team is constantly adding new tools to Smart Charts, often from people like you on this channel, writing in and saying, look, can we have this and can we have that? And all sorts of things that have been added recently. There is now a video released every single time we do an update, so you guys know exactly what updates are hitting the system and how they benefit for you. But most of the time, It's just very clever tools to make your trading easier, your analysis easier, and really just adding clarity to the picture. I'm really loving the interactivity of the development team behind this and how quickly they're adding new features. So I'm getting kind of excited about that. You can probably tell. But let's have a look at Aussie, because that's what I'm looking at the moment. I'm just going to remove some of these old drawings that I had off previous sessions that we've had together and just show you this consolidation. Now, I quite like the look of this consolidation. I like the picture here, which is above that 7330 level, 0.7330 level. To me, says there's some upside potential if you look at the chart, and could top out at 7412, something like that. So there's an area here which I like the look of. We're nicely above the 50, we're nicely above the 200. We've got positive news out in Australia, and there are buyers of Aussie out there. We know, we can see that on the chart anyway. So there's 100 pip upside here, and I like the look of that. Now, obviously, I'm not going to place a trade on this on the daily chart. In order to find entries and exit, kind of go down a level into some smaller time frames, often the 4-hour chart, often the hourly chart. So let's dig into that. If I bring up the 4-hour chart here, you can certainly see, if we go back a little bit further, what the real picture is. Now, so this is really like taking that daily chart, but just kind of breaking it down into 4-hour segments. And from doing that, we can then start to size up, well, where would our profit targets be? Where would we place our stop loss? What makes sense? Well, what makes sense, obviously, if we just expand this chart to here, we could say, well, look, if we were to drop and just use this tool, just as a measuring tool more than anything, you'll now see the take profit, buy entry, and stop loss has now been flicked to the right-hand side. It just kind of makes more sense for it to be there. So there's lots of cosmetic changes like that, which can help. And therefore, you get a nice, easy read of what you're doing here. So you can see, well, look, if I was to target 72 pips on the upside, right? Then if my buy entry was just above this level here, which let's say that would be that 73.41 level, clearing that 73.30 level, then really clearly, where should the stop loss be? Well, look, we're looking at this on the 4-hour chart. Where has the market found some noise that it's sat underneath? And that noise would be underneath this level here. If I could just move that out of the way and just show you with my mouse, this level here. So this is where it's found some reaction. And so that could be a nice setup for me on my trading account. That's the kind of thing I like to look up. Then I get a nice test here by just checking. So I can call this I can call this something and say, well, there's no strategy on this. This is my Aussie idea on the 23rd of November. There you go. I've now labeled that so I know what I'm doing and why I'm doing it. I'm happy. I can save this trade template if I want. So there's just extra buttons been added to make things just easier. So you're just doing less mouse clicks. It shows me my take profit there would be 72 pips from the entry. The buy entry would be the price of 73.41. So clearing that 30 level, which I quite like the look of. Stop loss is about 49 pips away. And so that, if there would be further upside potential on the Aussie, I could put a no expiry trade on that. And I could let that go. If I wanted to put a time period, I could, but I wouldn't. I would then just hit the green button, and then that would put that trade as a pending order. So should the market then hit that level, I would then be triggered in at 73.41. Might be able to get as far as 74.13. Not going for the top. Actually, that would be pulled down. That's right at the top there. Don't like that. I want that inside that. And that's how you then correct it. And then there you go. You're trying to take the market before it reaches its full potential. And that's how you could set that trade up on the Aussie dollar. And that's kind of what I'm liking the look of. For myself, that would be something if it gets there. Now, there's no telling if it will get there. We use orders most of the time in our trading because rather than trying to hit something in a live market, which often you can get wrong, I like to place trades and like to analyze trades with a view that certain support and resistance levels need to be breached in order for me to get into those positions. So Aussie's something I've got my BDI on. Let's have a look at Euro as well. Why am I looking at Euro? Why am I looking at Aussie? Well, there's some good news out there. Things are starting to turn around. There's a light at the end of the tunnel. And so we're going to look at this again from that macro or that higher time frame, that daily picture on the Euro. Again, look. It's the similar picture to what you're seeing on Aussie. You're breaking out of this range. Look at the amount of resistance we've had here, 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 and here. I'm going to do a pop quiz on this one. This is the daily. Let's then jump down to the 4-hour chart on this. I could easily access that just by hitting that. And then you'll see I might need to just scrunch this down a little bit more. Now you can see the bigger picture. And if I was to say to you, and we'll do a little bit of a quiz on this for a cap. Remember, if you want to compete, give yourself a cap. And if you haven't seen what the caps look like, they look like this. There we are. If you want a cap like this, which I'm happy to send out to you, do need to put your email address on the comment field and the email address you want my team to contact you with, because we will need your postal address. Many people on the YouTube channel have been saying, yeah, Greg, I'd love a cap. We're like, where do we send it? It ain't digital. It is a physical thing. So make sure you put your email address on if you would like a cap, and we will certainly send one to you if your numbers are good enough. When I say if your numbers are good enough, I want a real good understanding of where you think, based on the analysis I just did on the Aussie, see if you can transpose that onto the euro and see if you can come up with sensible entries, sensible exits, and sensible places to put your stop loss. And maybe you could give us some kind of understanding as to where you think maybe the stop would be. Would it be around here, for example? Would the entry be, what would you need to get through for the entry? And then how far up do you think you can go? What, therefore, these are my questions. What's the 3 orders? The entry, the stop loss, and of course the take profit. They're 3 orders. Those that are closest to what I think the numbers should be will win a hat. Don't forget to leave your email address and give me an understanding of the risk profile. How much risk would you place on this trade? If you were to place this trade, I'd be really interested to hear what you guys have to say. So there's an interesting image there on Euro, interesting image there on Aussie. Very similar, the two. Let's jump to Sterling, the Sterling picture. And let's have a look at what has happened on Sterling. Now, we watched the big bump on Sterling last week, did we not, when we got the news of the vaccine, over 90%. Apparently, if you take the vaccine in a small amount and then you supplement that with a larger amount, it's even more effective. So there seems to be positive news coming across the wires on that. Markets are loving that news. Markets are desperate to get out of this real hellhole that we've been in, which is 2020. And get us into more greener pastures. So you can see that across most of the markets. Sterling, here's a classic example. This is the daily chart, trying to break out again to new territories. What's the problem with buying sterling? If you're going to buy sterling right now, is there an issue there? Is there not an issue there? What's the picture of this chart? I'd love to hear your feedback on it. To me, it's pretty obvious, but I'd like to hear what you guys think. So you can put yourself in a little competition for that as well, if you like, by putting your email address in and telling me what you think the image or the picture with the sterling and what the issue there would be. So there are some of the ideas. Now, let's just do what I always do on a Monday, which is jump and have a look at the daily picture for the FTSE 100. And now you know that Smart Charts runs a bunch of different strategies where it's looking to find trading opportunities based on some presets, of course, the preset strategy. You can see that's being triggered now. Now, look, this was the rally that we had last week. If you notice, look, this was steadily, look at this channel I drew in here. Look, remember this was like, this has been the year of hell, right? This has been June all the way through to November, which is we've been steadily downtrending, and then wallop. In the last couple of weeks, we have the vaccine news and off we go to the races. This was the big day, and then here on in, we seem to have consolidated and holding this picture. Well, we still are waiting for further Brexit negotiations. That means that we're seeing a little bit of softness. When we say softness, where would be an entry on the UK 100? Well, this is an interesting tie-up. This is the, as you know, the main pivot point line. We don't trade anything unless it breaks south of this blue line. South of this blue line. That's the main pivot point line. For those of you that have never traded pivot points before, just take a look at this channel. You'll see some instructional videos on how to understand pivot point lines. But basically, they're calculated from the previous trading sessions, trading activity. We look at the highs and the lows, where the markets have peaked out, where they've troughed out. And they generate what's called pivot point lines. These are Fibonacci corrected pivot point lines, which means they take in some numerology, if you will, of the cyclicity of numbers, just to perfect but basically they're supposed to be turning points in the market. These green lines are supposed to indicate resistance lines. These red lines below, if I just bring them so you can see them all, are supposed to indicate support lines in the market. So you can see price does seem to have an interaction with that. The rule of thumb of trading in a session is that we don't go long on anything unless it's clearly broken above the main pivot point line, which is this light blue line running through the middle. So that is a really important point of clarity. If this market was to break through this blue line, that would indicate there was more sellers in today's trading session on the FTSE 100, and then we'd be looking for opportunities to maximize that or to capitalize on it. One of those could well be the breakfast breakout. So if we see a combination of this breakout happening as it seems to be happening now, you can see this is the range. Remember, the breakfast breakout range is that first hour of the day. And then markets seem to be bouncing along, but there's some solid support here. This is the 200 on the 5-minute. And it seems to have bounced off it this morning. It was called this morning. This would be the stop loss here outside that range. And it's bounced off it again here. So we can see the markets are not getting through. So what we're looking for, of course, is should the market break through here and it combines with here, then we've potentially got a trade on. Don't forget, though, however, this is a short-term play, and it would be a short-term play. If you look at the FTSE 100, you can see that big rally, this big promise of the light at the end of the tunnel in the COVID-19 nightmare. The price is now above the 50 and the 200. We wouldn't be looking to take too shorter positions on that in even the medium term. So this would be a kind of a contrarian strategy, trying to make money in a trading session. There's always risk in doing that. The shorter the time frame, the more risk on the table. You guys need to be aware of that. So they're the things we're looking at this morning. We're looking at the Aussie, we're looking at the Euro. I want your feedback on sterling. There is a play on the FTSE 100. Should it do the pivot breakthrough? And we have to make sure that's then consistent with this strategy here, which is that breakfast breakout play. So that is your little wrap up for this morning. If you have any questions, please do put them in the comment field. If you're not subscribed to the channel, please do get yourself on the subscription list. We'd love to have you. We're bordering 100,000 and we'd like you with us. And if you like this video, don't forget to hit like. Now, please do join any of the competitions I've mentioned today. We are going to be doing prizes probably within the next 2 or 3 weeks when we cross that 100,000 line. I'm excited about it. So are the whole team. So we're going to try and make that special for you. And yet again, if you're interested in joining me on a live analysis session, what I'm going to do going to start to look at doing those on a Monday, maybe a Wednesday morning to give you guys real access to me, live in context, then please let me know in the comment field too. Until then, this is your host, Greg Secker in the Trading Den. I look forward to seeing you next week.
Simon and Joe both invest in stocks. Simon uses eToro to invest in stocks without paying commission. Joe has to pay his bank a commission every time he buys or sells a stock. Simon uses copy.
Hi guys, well today we have a special session for you today in the Trading Den, but it's just me in the Trading Den. My entire crew, cameramen, the mixers, the producers, the script writers, not that we really use script writers, but we do have people who kind of collate all the questions and so on that we have on the channel. They're all gone. It's literally just me in the Trading Den, but therefore today it's just you and I exclusively here, and I'm therefore going to teach you one of my favorite tools of all time. Today I'm going to teach you how to place and trade and profit using Power Pivot. That is going to be covered right here, right now. Okay guys, so here we are in the Trading Den. It's very eerily quiet, but that's good because it gives us some lovely concentration time. And today I'm going to show you the tool that kicked it all off for me, and it's all about pivots. In fact, many of you might have Googled me on the internet and seen me make £19,000 in about 4 minutes. Trading sterling, I think it was, back in those days. God, it was over literally 15 years ago, that particular trade. I'm going to show you today how I use Power Pivots. Now, Power Pivots is a real precision way of making money in the markets. For those of you who are trading throughout this coronavirus time will realize that the markets have literally gone mental. 2008's got nothing on what's going on right now. The market volatility, look, I'm going to say this straight off the bat. Market volatility right now will crunch you in half if you don't know what you're doing. Because right now, volatility is utterly fantastic. However, the swings and the movements, as those of you that are looking at the markets are probably aware, are pretty insane. And for that very reason, we are having a field day, but you've got to know how to handle intraday volatility. If you are unsure, you need to go back and look at my video on the ATR, which is the average true range. That's a cracking video, which is going to show you how to measure, look, where you should be putting that stop loss. If you look at the euro dollar, in fact, let's have a quick look at the euro dollar right now. I'm just going to jump to a regular chart. Let's break up euro dollar just on the daily. Let's just take a look at the daily chart. I mean, just look at the vast swings that we've got up and down that's happening on euro dollar. Same thing is for sterling. Let's just go British pound against US dollar. And you'll see. Hold on, I haven't got these ones sorted in the list. There we are, there it is. Same kind of picture with sterling. So big swings up and down. You know what's happening right now. We're getting deaths every 5 minutes from different countries around the world. You've got Donald Trump saying all sorts of crazy things. You've got Boris Johnson, who's the Prime Minister of the United Kingdom, has just come down with coronavirus, as has the Health Secretary. So it's all a bit mental. We're thinking the UK may be in lockdown till June, and the Deputy Health Minister has now just said that could even be extended to December. So who knows what the hell is going on? I can tell you one thing. For currency traders, whilst from a humanitarian perspective, this is a disastrous time. And of course, many people are losing their incomes. Many people are having to really reevaluate how they're going to live their lives this year. Currency traders are having a field day. I mean, let's be really clear about that. There is volatility out there. And what we don't want is flat, snake-like markets. We want markets which are raging up and down. You only need to look at this chart to see that markets are raging up and down. So there is opportunity out there. The question then becomes, responsible trader, how do I harness, how do I tether that bull, and how do I make sure I can use it in a productive way to make money rather than just get slopped around, because there is a lot of slopping around going on out there. I'm going to introduce you now to a trading tool I've been using for literally the last 25 years. It's the concept of trading pivots or using pivot points. So this is power pivot points. We're going to get into that right now. So let me just jump to, if you look at my screen, you'll notice that I've got a little button here called Morning Pivots. And really what I'm doing here is I've set my screen layout in Smart Charts so I get a good view on what the markets are doing. Now, if you look how I've organized this, if I put my mouse here, you can see I've got my four screen layout is detailed as the following. I'm going to tell you how I do this so you can set your smart charts up to be exactly the same as mine. So you'll notice that if I click here, I can grid my charts for 4 charts. You want to make sure that's selected. Top left-hand corner, we're going to have the daily chart. That's D1 daily chart. So you select daily here, and you just literally pick daily. No strategy here at all, not useful, because we're literally going to do this as a manual setup. You'll see how the whole thing comes together in a second. Now you'll notice the green dotted line here is the 200 period moving average. Now that is the guideline for, is the market in an uptrend or a downtrend? It's a very broad kind of indicator which says, look, if the markets are trading underneath that 200 period moving average on the daily, we're looking at short positions. Now, we then move over to the next screen on the right-hand side, and you'll notice there's a green spot. Now, let me just click on that green spot. And what I've done is I've series linked these charts together, which basically means that whatever currency I select on any of the charts on this screen, it will update all the other charts. And the reason I'm doing that is I'm just using these 4 separate windows to have just a different view on the same world. Of course, right now I'm looking at dollar Swiss. That's USD/CHF. And you'll notice I've picked the same color. So they're all the same color links. If I confirm that, it just means if I change anything here, it will update all the screens. See, look, I've just clicked on Sterling Kiwi and it's updated all those screens. Let me go back to the dollar Swiss though, because I want to focus predominantly on that. There it is. Right, now, you'll notice I've created a green dotted line, which is going to be the 200 period moving average. If you don't know how to put that on your chart, let me just quickly show you how to do that. You come across and you hit here indicator, and I've got in here EMA. So you just type in here EMA and it brings up the exponential moving average, and then on it goes. Now let me show you how you edit the exponential moving average. Let me just remove one because you don't need 2 moving averages of the same number. I just then hit this cog, this settings button here. And all I've done is I've said source is closed, it's exponentialized, which means it gives more pricing relevance to more recent pricing data. So that's exponential. The style I've picked is dotted, nice fat line 4, so it's obvious, and I've made it green. I update that. and that gives me that dotted red, that dotted green line, which is the 200 period moving average. On dollar Swiss, you can see that price is underneath the 200. So that tells us that's a tick for a short. Then we move across to the 4-hour chart. Price is underneath that. That's a tick for a short. Then the bottom left screen, now notice I've just added the same indicator to all of those screens. I can even save that profile of indicator if I want. All I just would do is I hit the save button here, and I can call this, I don't know, call it Greg Pivot, if we like. And I can say save that, and that's now Greg Pivot. Then if I then open it, if I then want to add it onto here, I'll just hit Greg Pivot, hit the plus, and it adds it to there, you see? So boom, done. But obviously I want to keep it nice and simple like that. So I can add, let me just close that. I can add any of those profiles or templates I want to any of my screens. That's completely acceptable. Now, bottom left-hand corner, I've got the hourly chart, so I can see price is again underneath that 200 period moving average. And then here, and this is the interesting one, is my 5-minute chart, okay? And that is the one that I'm going to have my pivot lines on. So what am I looking to do? Well, let's open up the action window, is the window which is bottom right. That's the one where all the trading activity is going to take place. So I'm going to open that window right now, and you'll see, if we can just drag this down. Now you can see this main pivot point line. Let me just change my my cursor to a grab tool. Let me just see if I can bring this now. Okay, great. So you can now you're getting an understanding. Now, you can see price is sitting right in the middle of that main pivot point line. So what is a pivot point line? How are these pivot point lines calculated? What is the game all about? Pivot point lines are calculated from the previous trading session's activity. So you'll notice the main blue line is an important, that's called the main pivot point line. If the price is below that line, we look to take short positions. If the price is above the blue line, we'd look to take long positions. However, we would not be taking a long position here because we're actively seeking short positions here. So if you look here on here, we would wait for this price to break below the blue line, and then we would run it just north of the first red S1 line. So this is the support first S1 line, this is S2, and lower down here will be S3. Above is R1, which stands for resistance line 1. This is resistance line 2, and of course this is resistance line 3. So on the dollar Swiss, I can take this trade on. Now let me show you how you can kind of make this a little bit better. So I would take this trade on if I get a confirmed break below that pivot point line. Now you can see markets in the dollar Swiss market are sitting right on the pivot point line. There's really no major direction moving here. That's okay, because that means it's potentially going to break down or break up. If it breaks up, I'm not interested in placing the trade whatsoever. I'm only interested in placing a trade which would go short. Because why? Because I've got all the major market direction in my favor. Look to the left. Is the price below the 200 on the daily? Yes, it is. Is the price below the 200 on the 4-hour? That's this top right-hand chart. Yes, it is. Is the price below the 1 hour on the 200? That's the bottom left chart. Yes, it is. And then finally, where I do my work, my action, is here on that bottom right chart. Now hit the middle button there on Smart Charts, which will expand that screen so I can really see what I'm doing. You'll see price is now stuck onto that pivot point line. That is an uncertain market. That's okay. When market gets some direction, if it continues in the same direction, physiology of the other major time frames, when we're looking up to get our major time frame direction, that daily, that 4-hour, that 1 hour, which is pushing down, we want to set ourselves up to catch this little fish if it's going to move in our direction. Let me show you how you do that. So all I'm going to do here is I'm going to hit the short button. Now I'm going to move my lines around. So I hit the short button and I say, look, I'm going to take profit north of the red line. I'm going to have my sell entry. And if I'm smart about this, I move my short line just south of where we've had this. So I'm going to let it clearly break through that major pivot point line. And I want my stop loss to be up here. So I've got some nice protection. So you can certainly see, look, I'm risking £2,000 to make 2,600. And why have I put it just north, let's say, of this R1 line? Because you're going to find that price is going to bounce off there. If it drops through here and enters me short, for it to come all the way back and break through the main pivot point line and could break through the R1 line. It's a dumb trade. It's a duff trade. It hasn't worked out. But I'm giving myself plenty of protection. I'm putting my stop loss behind the main pivot point line, which is now has got to break through to go short. And I'm putting my stop loss above that R1 line. That's really going to be important. That's going to give me lots and lots of protection. Plus, I've got more profit to make than I'm risking, but it nearly is a one-to-one. Profit is a little bit more in my favor. So I like the look of that trade. I've got all the major market direction in my favor. The price would have to break down through the pivot, and I'm making sure that it's breaking through enough of this support, which is formed just underneath the pivot point line. So I want to make sure that I get through the pivot point line. I want to make sure I break through the price support that's there, and then it's on its way. To victory. My take profit should be north. Should be north of that major support line. So it's basically a one-to-one nearly kind of trade. I like the look of it. I then just hit go, and then that is all set up and it's ready to trade. Let's have a look at a couple more just to give you an understanding of how that works. But hopefully you can see there's a structure to this. There's the daily, there's the 4 hour, there's the 1 hour, and then the action happens on that 5-minute chart. Let's look at a couple more. I did spot Euro Yen this morning, so I can literally, these are all series linked, so I just click on one and it should update all of my charts. There we go. So again, I've got price on the daily, which is below the 200, as you can see. I've got price just below, around the 200 on the 4 hour, price just below the 1 hour. Like this look. We like the look of this because we're just breaking through those 200 on the daily, on the hourly or on the 4 hour, which means we could have a good push from here. Let's open up the 5-minute chart. Now we can see what's happened here. Well, on the 5-minute chart, we're already through the main pivot point line. That happened this morning. Look at that. High test off this morning. Lovely run down. The move's already happened on that. Okay, fair enough. So what happens? How else can we play this? Well, we can look, if the market comes back and touches again towards the 200, that can give us an opportunity to go short. We can put a short position on that, no problem whatsoever. And that means that then if it does, we can put a sell stop here with a stop loss. Let's put that in. So I can put my stop loss above. I can put my sell entry if we hit around this level here, and I can put my take profit right back down to where it was before. That should then give me, let's have a little look. Yeah, I'm gonna put my stop loss just north of the pivot point line because that is going to give me enough resistance protection. Quite happy with that. There's no point in putting it all the way at R1 because we can see the range where the Euro Yen is. You can see what happened early this morning. Touched up through the pivot point line, fell, hit a lovely, good old 70 pip run this morning. Could go ahead and do that this morning. So I can just leave this bait in the water. If the market comes back and touches that, I'm going to be short at this level here, which is short of 119.85. Stop loss at 120.31. And my take profit, if I can use my eyeballs, 119 spot sort of 20 or somewhere around there. 20, no, actually 15, I think. Yeah, 13. Okay, 119.13 or 11. Doesn't matter. It's there or thereabouts. In fact, actually I want it. Yeah, let's go 11, 119.12. That would be the preferred number. So yeah, my profit target is 3,300. I'm going to take, my trade size is 6 lots. By the way, if you're concerned or you're worried or you don't understand how to trade size properly, Smart Charts does this so beautifully and so elegantly. On the right-hand side here, look, I just put in the risk on my ultimate account. There's 104 grand in this account. So I'm only going to risk 2% of my account. Then Smart Charts cleverly figures out how many lots I should use, or if we want to do spread bets or pounds per points or contracts for difference. It really doesn't matter. You can actually trade size in a variety of different ways. Pounds per point, lot size, cash amount, whatever you like. Anyway, so on the Euro Yen, you can see again, I've got all that trade confluence is what we call it in the mix. So I now can hit, I can put my expiry because it's a pivot is end of day. So I'm going to stick that on end of day. In other words, if it doesn't happen by the end of today, those pivot point lines are irrelevant. So I want this trade taken off the table. I didn't do that with my last trade. Let me show you how you go back and do that. I literally can shrink the screen right down. Then I go back to trade. You'll see the 2 trades I just put on. Let's put pending here. And the first one I did was that dollar Swiss. And you can see that trade is in. And there's my expiry. I put no expiry on that one. So I want to go and change that trade. So let me pick this one back up. There we go. So I've clicked on it. Now watch. If if I bring the trade ticket, change my expiry here, and I put end of day, and then I hit OK, it'll then put the end of day, which means that it's going to be in 9 hours and 23 minutes. And there you go. You can see the countdown clock is ticking. So if I go back to my charts, let's just have a quick look at sterling. Last one I want to have a look at, and then you'll get a good understanding. You can see now it's put a dotted line. Do you see the dotted line on the top? That is when the trade expiry is going to happen. If I open up this screen here and I scroll along, hold on, you'll see this dotted line. That dotted line says this trade will be taken off the table if it hasn't triggered at this point. So that gives you an understanding of how the trade management system works, okay? And let's just do one more. A little sterling trade again. So we've got price. We haven't got confluence here. Price is above the 200 on the hourly. Was it sterling Aussie? Perhaps I was looking at this morning. Yeah, you've got a lack of confluence here again. So you've got price above. Here we go. This is a bit better. And you've already had the reaction. So sterling Aussie price above the 200 on the daily, as it is on the 4 hour, as it is on the 1 hour. Bringing up then the action charts for these pivots. Look at this. I mean, this is a volatile market, no less, right? But let's just bring that across. So this is your 5-minute chart. Now you can see price has broken up through the 200, through the main pivot point line here. Your profit target would be the R1. We're not in an ideal situation to enter this trade for obvious reasons, because it's either in play. I don't like the look of trading this above that, so that's not something I want to do. But you've got the two ones on there, the euro yen. The reason I wouldn't enter this one is because either we would want to make sure we've cleared this, these would be intra pivot point resistance areas, and we want to get it on a break through the main pivot point line here. That's already happened, so that's not to be traded right now. But the euro yen one we can keep watching, and the dollar Swiss one, have a look yourself on your copy of Smart Charts. If you haven't got yourself a copy of Smart Charts, look in the description of the video here, and there's a 7-day free trial of Smart Charts for anybody who's a subscriber to my YouTube channel. Just take advantage of that. You'll find there's lots of training. If you're not, one of the things I want you guys to be really aware of is I try and put lots of great content on the YouTube channel. I know lots of other people who run their YouTube channels run it as advertising campaigns. Look, I believe in just giving you the content and the training on there, and then, you know, and I think if you just serve people and give them as much great content as possible and help them, they'll make a decision whether they want to go ahead and do the full training. But I will say this, and please don't think this is a big pitch or anything, but the training in Smart Charts is incredible because it's been chapterized, which means we build you up. There's a whole trader cycle which has been built up so that each layer sits on top of itself. So then when you get to the kind of training I'm doing on YouTube, you're going to go, oh my God, yeah, I see exactly where that slots into the grand scheme of things. So we've put probably about 2.5 years of thinking into how to structure this in such a way that it's modularized, but you can then follow it, and you can and you can really build yourself from the ground up. So if you haven't got a free copy of Smart Charts yet, it runs for 7 days. Grab it and then go through all the training, because I think you're going to find that to be incredibly powerful and helpful. So that is my power pivot strategy. Let's watch those over the next couple of days. That euro yen, that dollar Swiss trade. Remember, it's confluence of all of the time frames. We want to make sure we got that done. And if you enjoyed this video, please hit like. If you haven't subscribed to the channel already, make sure you get yourself on there and do that. And don't forget to look in the description if you'd like to get yourself access to Smart Charts. There is a hell of a lot of tools. I've only shown you a little bit so far. Grab that. And if you're at home in isolation, which seems to be the case for most of the world, please take care of yourself and your family, and look forward to seeing you at a future training video from here in the Trading Den.
I wouldn't blame you if you didn't watch this. See, there's Apple Music, not to mention Apple TV Plus. Whoa, we did warn you. Watch out, there's more. Brace yourselves. Are you still watching? Get EE Business Full Works Plan for iPhone, or get Plan Envy.
Hey guys, Greg Secker here. Well, listen, we are back in the trading den. It is raining. It is Great Britain in March. And today we are hitting one of the most important indicators. This is the mother lode. This is the indicator that professional traders use and baby beginners know nothing about. It is known as the ATR indicator. We're going to be covering it right here, right now. Okay, so what do we use the ATR indicator for? First off, let's go through the benefits of this little known indicator used by, let's be honest, successful, consistent, professional, successful currency traders. Beginners spend their time looking at RSI stochastics, MACD, or otherwise known as MACD, and a whole host of other indicators. And whilst they are important, nothing, and I mean nothing, has the value of the ATR indicator. So today on the channel, we're going to cover that first. So what do we use it for? Well, the ATR indicator is used to identify really explosive trends that are about to break out. In other words, it's a great indicator for knowing where it stands for the average true range of what? Well, the average true range of volatility, of price range movements. And we really need to identify multi-year lows in terms of volatility on the ATR or on a weekly period. And if the weekly ATR, or that average true range, is at a multi-year low value, meaning that the price range movement has gotten quite quiet over a long 12-month period, it means something big is about to happen, as the Forex market, as we know, does not stay quiet for long. Let's jump into the screen, take a look. So I'm going to look at euro dollar right now. I've got a really basic vanilla chart. As we know, euro dollar is the most traded currency pair, so this will bear the most truth to my prevailing statement. First of all, let me show you how you add the ATR indicator in Smart Chart. So we go across here to indicator. If you can't find it, you just type in ATR and it will find the average true range. Nice rapid search function there in Smart Chart. So I bring up average true range, I click on that, and it populates it straight into the window. Now, if I want to change any of the settings on the ATR, I would literally move my mouse over to where it says. Hey guys, Greg Secker here. Well, listen, we are back in the trading den. It is raining. It is Great Britain in March. And today we are hitting one of the most important indicators. This is the mother lode. This is the indicator that professional traders use and baby beginners know nothing about. It is known as the ATR indicator. We're going to be covering it right here, right now. Okay, so what do we use the ATR indicator for? First off, let's go through the benefits of this little known indicator used by, let's be honest, successful, consistent, professional, successful currency traders. Beginners spend their time looking at RSI stochastics, MACD, or otherwise known as MACD, and a whole host of other indicators. And whilst they are important, nothing, and I mean nothing, has the value of the ATR indicator. So today on the channel, we're going to cover that first. So what do we use it for? Well, the ATR indicator is used to identify really explosive trends that are about to break out. In other words, it's a great indicator for knowing where it stands for the average true range of what? Well, the average true range of volatility, of price range movements. And we really need to identify multi-year lows in terms of volatility on the ATR or on a weekly period. And if the weekly ATR, or that average true range, is at a multi-year low value, meaning that the price range movement has gotten quite quiet over a long 12-month period, it means something big is about to happen, as the Forex market, as we know, does not stay quiet for long. Let's jump into the screen, take a look. So I'm going to look at euro dollar right now. I've got a really basic vanilla chart. As we know, euro dollar is the most traded currency pair, so this will bear the most truth to my prevailing statement. First of all, let me show you how you add the ATR indicator in Smart Chart. So we go across here to indicator. If you can't find it, you just type in ATR and it will find the average true range. Nice rapid search function there in Smart Chart. So I bring up average true range, I click on that, and it populates it straight into the window. Now, if I want to change any of the settings on the ATR, I would literally move my mouse over to where it says ATR, and it'll pop up a small window. I can change all my parameters here. I can change the number of periods. The period setting we want to use is 10. So here's what we're going to use, ATR 10. We're going to look over a 1 year period. So I click on 1 year down here, which now it means it brings the whole year's worth of data into the window. I'm looking at a daily chart. Now, Notice, when the ATR first of all loads on, it will look something like this. I want to now stretch this up so we can see where the peaks and troughs of the indicator are. And the point I made was that when we are at a multi-year low value, so let me show you where the multi-year low value is. Again, I'm going to go to one of my tools, highlight where the multi-year low is. So if I click on drawing and arrow icon, that's the one I want. And I'm going to point to it very clearly on the chart so you can see where the lowest point of the year was. Now I'm going to drag the indicator down so we can focus more on the chart. And this point here correlates, as you can see, from this low point of the arrow, correlates to around here. And if we then look at what happened, so this is when the volatility flattened right out at the multi-year low. We then can draw a price range movement, so we can measure price from that range, which is around here. And we can see from this movement here, we had a small rally and then it gets going and you've got about a 250 odd pip movement from that low volatility point. So what that really tells us is that volatility is really flattened out. Now it's got to the low point and generally something is about to happen after you get to that low point. You can certainly see here, after we got to that lowest point, it would then break out and we get the volatility moving again. That's what happens in the currency markets. There's always an ebbing and flowing between low volatility periods of time and higher volatility periods of time. So that's the first use of the ATR indicator. Not the most common use, but one of the first uses to show you when volatility is getting low. We plot that on a daily chart. So the first thing we did was we select daily. Then we hit the 1 year button. That gives us a year's worth of data. Every bar on the chart is equivalent to one trading day, one 24-hour period of trading data. Then we added the ATR, that's the average true range. That gives us the average of price range movement over a period of 10 days. So it looks as a moving feast of 10 days and it plots a curve as it has done here. We look at then the low point over that 12-year period or that rolling 12-year period. And at the low point, we're then looking for the markets to get moving and create an explosive trend, which indeed, look at the trend, up, down, up, down, up, down, up, down. So it's an explosive trend as per the prevailing comment. So that's the first use. Now let's have a look at another use of the average true range indicator. We're really going to use it to predict market turning points and identify high probability trend reversals. Now the market only has a certain average amount of potential energy in any 1 week. So we use this knowledge to our advantage by looking for a market that has moved more than 1.5 times, so the market structure itself. If it's moved 1.5 times more than the ATR, we then expect a reversal to have happened. So let's go and have a look at that. So let's have a look at what's been happening more recently. And I'm going to look here at actually measuring the ATR. So we notice here, now here is a market which has reversed. I'm going to use this as an example. So take a look at where the ATR currently is now. So let's have a look where so let's say markets has moved quite steadily up to this point. So if we measure the price range from, say, take this little trend movement up here, then we have the market fall away here. So let's take a measurement of price between, say, this area here and this area here. And we've got about 240 pips, let's say, in terms of this upward movement, this short-term trend over the last few months, let's say. Now watch, so I take the same box and I see that the market's 42 pips as it's moving up. We're now at 51 pips. And now we are at 47 pips. Yet the market over this period of time has moved in excess of 245 pips over this period of time. So effectively what you're seeing is that, and this obviously is indicated by this big jump of price movement here, the market is well in excess of 1.5 times the ATR. So if I just take, even if I take a single point in time, take these last week in time, this is a great way of looking at just a week of data. So take, for example, here we're looking at a range of 50 pips right down to about 46 pips. So 50 to 46 pips, 1.5 times that would be, 90 to maybe 100 pips. That would be double. So 1.5 times would be sort of 80. Now look at the price range movement here. We've got well in excess of that 243 pips. We then top out, then the market reverses and changes direction. So what we're noticing here is that when the price moves in excess, in other words, we've got an expansion of price range movement, which is at least 1.5 times, or here it's over 4 times, 5 times greater, then we expect a decent market correction. So when the ATR range is magnified 1.5 to 2 times even by price, we expect a correction. We then see that correction play out only a day or two later, and then the market starts to move. So that's a classic turning point. So a couple of recaps there. We've looked at the ATR for telling us when an explosive trend is likely to happen. We've also looked at when a turning point in the market's likely to happen. Let me show you another use of the ATR, which is critically important. Now, look, we can use the ATR, and this is probably one of the most important uses of the ATR possible. This is about setting up a proper stop loss so you live more of a lifestyle trader than being like everyone else that gets stop hunted. Now, stop hunted means people who set their stop losses way too close to resistance levels or way too close to below support levels. You know, it's highly used. It's very stupid. Different markets, of course, have different volatilities. And so I'm going to just jump on the screen right now and give you an example of how just by only using just price action alone with support and resistance areas is a kind of a dumb mistake. Just take a look at the chart I'm on right now, and I'm going to draw in by freehand a line of resistance. I'm going to say if the line breaks above this line of resistance, I'm looking to go long, let's say. However, I need a stop loss in as well. So let's say my stop loss is going to be along this horizontal line here where there's price. Let me just move that to right place. Let me just see if I can draw this in different colors just to make it really clear. So I'm going to say that support is going to be down there at green. This is going to be my resistance line up here at red. That's what I'm saying is I'm looking to buy above here. Okay, so let me just kind of annotate that for you as well. If I put in a little bit of text, let me see if I can put in a little text box for you. Here's some notes, that's what I'm looking for. A note balloon. So let's say I'm looking to, I'm buying above the red line. Let's just add that in. That's my breakout above resistance, classic idea. And I'm just going to move that down here so we can see that's my intention, is buying above the red line, should price get through. But I want to make sure I put a stop loss in. So the average guy or girl is going to put their stop loss in somewhere around here. Let me see if I can kind of make a little annotation of that for you on the chart to give you an understanding. So that would be somewhere, you know, just below, let's say they put somewhere there, somewhere just below where the support line is. So we want to buy as it breaks above the resistance. We want to put our stop loss just below support. Now, the point here is we don't want to use a fixed stop loss. First, let's identify the market structure. This here is the market structure. It's a breakout. It's what we're looking at placing. It's a long breakout on euro dollar. And then set our stops away from the support, but give it the breadth of what the current ATR is. This is the, if we now look here, let me change this grab tool, which allows me to move the chart around, to a crosshair tool, which allows me to read the values on the chart. And I now move my crosshair down to this. And it says, well, look, Greg, if you look here, my volatility at this time is like 14, maybe 10, 14 pips away. So my market is moving around 14 pips at the moment. So if my stop loss is down here, which effectively is like a point or two away from where this support line is, the probability I could get stopped. So I'm going to say where this squiggle is where the average person might put their stop loss. I'm actually going to, I've read off here that it says, look, around this time here, my ATR 15 to maybe 12. So I'm going to say like maybe my ATR should be 12 to 14 points. Give it some breathing room. So I'm going to measure where that is on the chart just to show you how powerful this is. And I'm going to go from the bottom here and I'm going to say, okay, I'm going to give it the breathing room of maybe 12 or 13 pips like that. So my real stop loss using the ATR should be at the bottom of this blue line, because I've used the ATR to give me an indication of how much market is moving around in this market structure. And so I'm now going to draw another horizontal line, and this one I'm going to put right at the bottom here. And I'm going to say, okay, this is, the yellow line is where my intelligent stop loss should go. Now let's play the market out and see what happens. So your average guy or girl puts their stop loss just below the level of support because they think this is where it should go, just below that. Let me just give it a couple of pips. The intelligent person uses the ATR 10 and says, no, it should be this amount of movement. Now let's move along and you'll notice, look, this person easily got stopped out. And this is a classic. If we'd have placed our stop loss by licking our finger and sticking it in the air, which is what 90% of currency traders do, beginners, intermediate, and those who call themselves professional, they're literally just putting their stop just behind a support resistance level. We don't want to use a fixed stop. We first identify the market structure. Then we set our stops away from it using the ATR. Set the stops away from the market structure because the ATR can help with keeping you profitable through what are quite volatile and changing market conditions. Notice on this example here, we would have quickly and easily got stopped out where the average person would have put their blue line, but we've put ours on the yellow. It's kept us safe, done exactly what it should do, and therefore ensured that we can then ride out the position, get ourselves then into a profitable trade, and we can get moving from there. So that is critically important to realize that the ATR's most prominent use and most powerful use is knowing where to place your stop loss. We use the ATR to ride massive trends without getting stopped out on these minor retracements. So we're using a volatility-based trailing stop loss, and that's a multiple of the ATR to avoid this common and widespread example. Let me show you an example of that. So if I jump onto, for example, smart charts right now, and I've got my buy and my sell button. Let's just say I hit my buy button. Let's go to, let me just go to where the current price is, hit auto scale. And let's say we were looking for some reason we wanted to get long in the market. Let's say we decide to get long in the market here, which says a buy entry here. Let's say a stop loss. It's suggesting a 20 pip stop loss. It doesn't mean place a 20 pip stop loss. It's saying, 20 pip stop loss is suggested. Now, given you're just placing a no strategy at market trade, where do you want to put your stop loss? Well, a great idea here would be to use the ATR 10 again. So I'm using my crosshairs. I'm now dropping my crosshairs down to here. What does ATR say? It says, well, you should at least have 18 pips away from where your current market price is. It's 20 pips away. I'm certainly within my ATR. So if I want to ride a bigger movement, no one talks about a guideline of multiples for the ATR. And so to guide you, think of it like this. If I want to just jump in and grab some profit, great. 20 pips on current market volatility, this is fine. But if I really want to ride a much bigger, a much more medium-term trend, then I want to be thinking, the golden number here is 3. So my stop loss wants to be 3 times my current ATR. My current ATR right now is 18, 19. Yeah, 18 pips, if you can read that on the scale there on the ATR 10. So 3 times 18 is what? 54 pips, I suppose would be the answer I'm looking for. So 54 pips away from where current market price is. So I could set this down. I could literally just drop this down here as I move this all the way down to 54 pips away. And it's done it. Now it knows how much risk I'm taking. Now, obviously, I can move my profit target down. I can change the whole dynamic of this. But I now know that for a much larger trend, which would be, or at least a medium-term trend, 3 times current ATR is going to give me equidistant away to ensure that I can then ride that movement. Again, I'm using the ATR then just to allow myself access to a much more explosive growth. If I want something much more long-term, the magic number we're looking for is 5. So under current market conditions, that being 18, we're looking at a 90 pip distance from the stop loss to the current price, or at least where our stop loss should be placed. And all we're doing is we're multiplying 5 by current ATR, which is 18. So 90 to 100 pips away ensures that we can then ride a much longer term trend. So we're using the ATR. Remember, the ATR indicators does not tell you the direction of the trend. It's certainly not a trend indicator. It moving up doesn't mean market's going up. It just means that the open and closing price are getting further apart. It means that there is more confidence in that direction. If where open and closing prices are closer together, it means there is disagreement or it means there is a lack of confidence in that direction. When an opening price and a closing price are further apart, it means volatility is increased. It means there is confidence in that direction up and confidence in that direction down. Now, a huge point to take here is that if the market has moved more than twice the ATR into an area of support resistance, it could snap back in the opposite direction. And that essentially means you're in that expansive phase of a breakout where the open and the close price indicated by the ATR is at least twice the ATR, which means that you are looking to hit an area of exhaustion. So let's have a quick recap. First of all, what do we use the average true range, that ATR indicator for? The identification of explosive trends. We use it to predict market turning points and most importantly, set an intelligent, not a stupid one, an intelligent stop loss. Avoid getting stop hunted, that's the last thing we want. Ride medium to massive term trends. And remember, it's not a trend indicator. If you like this video, don't forget to hit like. If you're not a subscriber already, don't forget to get yourself on the subscription list. And if you check the link in the description of this video, you'll have access as one of my YouTube subscribers to get yourself a copy of Smart Charts.
To the hip hip hopper, you don't stop the rocket to the bang bang boogie. Say up jump the boogie to the rhythm of the boogie to beat. I gotta bang bang the boogie to the boogie. Say up jump the boogie to the bang.
1 million
Lady Million.
fragrances by Paco Rabanne.
Well, hello everybody, welcome back to the Trading Den. I'm your host Greg Secker, and today is going to be an incredible day. And the reason for that is today we are discussing the 4 stages of trading mastery, how to become an autopilot currency trader, how to use wearable technology to improve your myelination process, which effectively is going to speed you up to mastery, and that is the place every currency trader wants to be. We're going to be discussing that right here, right now. Okay, so as we get into this session, let me give you a bit of a backdrop. There was an incredible guy by the name of Daniel Coyle who wrote this groundbreaking book, and it's called The Talent Code. In his subtitle, he says, "Greatness isn't born, it's grown." And I'm a big believer of that. In other words, when we all talk about Mozart, we all talk about Beethoven, we all talk about these incredible people that have achieved the most incredible achievements in their life compared to the rest of us. But what we fail to recognize, and we always put it down to, well, they've just got good talent. Daniel Coyle argues that talent itself is not born, it is nurtured and it is grown by the process of mastery, which effectively is this. It is the process of myelination. Now, what does that mean? What is the process of mastery and myelination? This is something I really want to get into your mind, and it will give you a 4-step plan to greatness. And I genuinely mean that. I've been training and teaching this for nearly 20 years now, and this is the difference that makes the difference. How do you get a Mozart which can make the most incredible music in his teens? What people don't realize is that Mozart had done over 10,000 hours of training with his father, who was a top-rated piano teacher, long before anybody had even got to 2,000 or 3,000 hours. In other words, he practiced, but he didn't just do good practice, he did perfect practice. And he went eloquently through the 4 stages of mastery at a young age. Tiger Woods was hitting drives off the fairway, off the tee onto the fairway, front and center, straight onto the green at 4 and 5 years old. So this training happened for these people very early on, and they achieved mastery quickly. Now, there are 4 stages to mastery. And I want you to think of this, and I'm going to give you an analogy to say something else in our world, which of course is driving. Let's just take driving as an analogy. Well, the belief constructs around driving are there already, implied and in place for you. And what I mean by that is when you come to the age of 17, 18 years old, learning to drive a car for the first time, you've got lots of social proof that driving is relatively easy. It's a skill that can be learned quite quickly. And although despite the only thing that is stopping you from death is a simple white line in the middle of the road, which delineates you from oncoming traffic, we learn the rules, we practice it, and then we get in the game. And of course, the benefit of learning to drive means you get to escape your parents' house at 17 years old and you no longer have to use the taxi of mum and dad. But at the same time, you also give yourself what could be a very scary day. It's also a very liberating day. Trading, you certainly aren't risking your life. You are risking your money, of course. But of course, there isn't the social proof around us. Your grandfather, your father, your mother, your sister, your brother probably are not currency traders or any market traders for that matter. And so there is not the social proof around you to give you that implied belief construct that it's possible. So for many people, they simply can't see themselves doing it because they haven't had that in their world. Let's pretend for a second that you have built the belief and you have surrounded yourself with a peer group of individuals who are succeeding and certainly who are in the category of mastery, an autopilot currency trader. What are those 4 steps? Well, again, back to that analogy of the car. Let's take an 18-year-old driving as someone who's achieved mastery. Well, there are 4 stages to that mastery process. Stage 1 is what we call unconscious incompetence. That's unconscious incompetence. What that means is, in the analogy of driving, it's like being a baby. A baby doesn't know that in 17 or 18 years it will be driving, or he or she will be driving. Baby doesn't even know driving's important, doesn't even know driving's a skill to learn, and has no concept of how incompetent they are vis-a-vis being a successful, disciplined driver. They have no awareness of their gap that exists between them as a young child and of course being a competent driver. So that's what we call unconscious incompetent. I'm not aware of my shortcomings. That's really phase 1. Phase 2 is what we call conscious incompetence. So this of course is the 17-year-old who very much realizes that he's not a proficient driver yet, but he's in a school of tuition and training, he's being coached, he's going through all the processes that he needs to go through in order to close that gap. So he is consciously aware, he's training, but he knows he's incompetent. And many months later, he may be now driving around in stage 3, which is where he's got his P plates, meaning he's just passed his driving test. Everyone's aware that this is a new driver on the road with a P stuck on the back of his car. And he is what we call consciously competent. He can do it, but it's not automatic. He has to think about it. And that's really important because whilst it's not unconsciously competent, which is the highest level, number 4, he is competent, but a lot of his brain power is being used following plans, ensuring that he's, mirror signal maneuver, all of those things we learn, all those little routines and tricks that we learn, he still has to go through in his mind. And then by doing that over a period of months and weeks and years and so on, he gets to stage 4, which is unconscious competent. In other words, he's competent. He doesn't even have to think about it. It becomes autopilot. The routines, the systems, the structures, all is routine, it's embedded. And in fact, it's what Coyle would call, and what many neuroscientists would call, it's in the area of neuroplasticity, which means the ability for the brain to learn new skills quickly, and then of course embed them, which is where things become autopilot. There is a science to this, through what we call myelination. Now, myelin sheaths are these neurons which run through your body. Your whole body is an electrical chemical system which is perfectly and infinitely tuned. But of course, for you to learn a skill, for example, if you're a magician, which I am, or a piano player, which I am, or a helicopter pilot, which I am, all of those 3 things, and a trader, at some point I've had to master those things, which means at a technical level inside the body, you're talking about this little thin sheath of myelin, which is actually a fat substitute, wrapping around each myelin sheath. And the more it wraps around, it goes from kind of like a dial-up modem communication to like hardcore 4G, 5G broadband, where the signal is so much stronger. When the signal is strong, it means the myelin sheath wrapping around those neurons has become thicker, the communication is strong, and then you get to a place where even after half a bottle of champagne at a dinner party, you can still sit down at a piano and rattle out any Elton John song because it literally is programmed within your mind. That is a level of mastery that if you bring to the trading game, you can literally live in a completely different space. So you'll remember I did the Ultimate Trading Plan quest that we did that a couple of weeks back. That quest was all about giving you a 4-step plan to building your trading plan. And that, if you haven't done that quest already, I really suggest you go back and do that quest because that will give you your 4-step plan. Then how do we take that amazing plan and ensure that we are responding, trading, acting, and being consistent with that plan and not becoming a gambler? And this is the area of mastery. This is about putting that plan and putting your behavior on the correct autopilot path. But yeah, in order to do that, we've got to use some breakthroughs now. So those 4 stages we have to break through, really identify where we are. And as I now go through the 4 stages of mastery, and I'm going to describe it now, not in terms of a driver or a child, but in terms of you as a currency trader, which may be a novice at this time, or you may be somewhat inexperienced, but I'd love you to comment, if you will, in the comments of this video today as I walk you through the 4 stages of mastery. And then as I get to the end of this, I'm going to talk to you about some of the latest wearable technology you can use to actually accelerate your learning process. You know, if trading is a skill, which let me tell you that this is a skill, and that can be enhanced and sped up by the use of very clever wearable technology. In fact, there is some very clever brain stimulation wearable technology which accelerates the process of myelination. Now, when I first discovered all of this 2 or 3 years ago, of course, I've tried everything. I mean, I've tried all the latest wearable nootropics, meditation sensors, anything which can give me a cutting edge, anything that can give me, you know, the next level. And by the way, the advancements in this level of neuroscience and neuroplasticity has gone through the roof in literally the last 10 years. So you'll see, as I discuss at the end, some technology you can wear which can actually accelerate you through those 4 stages as quickly as possible. I proved it by learning Your Song by Elton John in less than a week. Fully sat down, no music, learning it, playing by hand, and I can now play that song because I was wearing this very clever technology which accelerated that learning process. That is something that you can add to your armory, to your tool set, because remember, this game is not about making money. This game is about getting you to be the best you can possibly be, and as an output from that, you will make money. But if we can get you disciplined with a really rigid, structured trading plan, and then get you unconsciously competent. In other words, you just do it on autopilot. You follow that plan, you act in accordance with that on autopilot, you are going to be in great shape. Let's discuss what we are trying to really achieve in today's training and talk about these 4 stages of learning. Incorrectly, it's been attributed to Dr. Maslow. Now, Dr. Maslow did the hierarchy of needs. That's really what he became famous for. The 4 stages of mastery and learning was actually discovered by another gentleman in the US whose name I will put on the screen right now because I can't remember it. When it's applied to trading and how we learn every single day, it will help you stick to the plan. Now, learning these 4 stages of mastery or learning will help you increase your awareness from where you are now to really where you want to be by understanding consistency versus intensity to become an autopilot trader. For example, you can't get into shape by going to the gym for 9 hours. It won't work. But if you work out every single day for 30 to 45 minutes, you will absolutely get into shape. Intensity is like going to the dentist. It's fixed in the time we know exactly what we're going to do. But if that's the only thing we do and then rely everything onto our dentist, all of our teeth will eventually at some point fall out. This is the difference between horizontal time and vertical time. Horizontal time says, I do a little bit to get to where I want to go each day. Vertical time says, I haven't done what I needed to do. Now I'm in emergency mode. Now I'm having my stomach stapled because I never went to the gym and I'm now too fat. I can't get in any clothing. Or now I'm having a divorce because the relationship, I never figured out working on it. I never worked on it every day. I just let it get so bad. And now I'm in a place where I have to change everything in vertical time. That's called the emergency plan. That's called the quick fix. And often that puts us in a bad place. So in other words, the intensity itself is not enough. We also know we're supposed to brush our teeth 3 times a day for 2 minutes, and that'll help you maintain a good smile without losing your teeth and get you into a routine. Now, the amount of money made in the Forex markets isn't about time. I think you're probably aware of that now. It's not about time, it's not about energy, and it's not about effort. Spending too much of your time sitting in front of the computer doing analysis paralysis is not going to get you there. This is about consistency and then sticking to your trading plan by doing low effort frequently to produce high impact. And that's really the game we want to be in. So let's have a look at phase 1 or stage 1 of learning, which we call unconscious incompetent. This is your novice trader. So this is the initial phase of a novice trader when he's just getting his feet wet in the markets. At this stage, a trader doesn't really know what he doesn't know. And that's an important distinction. That can be liberating because you haven't got too much on your mind, but it's a very dangerous place to be in because the dangers are not obvious to the trader. Trading decisions are pretty much still a gamble. They're not backed by a sophisticated decision-making process. And although the unconscious, incompetent trader will never admit that, in fact, they're going to be the worst because they're the least introspective of the 4 stages, they don't know any better yet. So the characteristics of an unconscious, incompetent trader, and as I say these now, I want you to think, is this me? And if so, mark yourself in the comment underneath this video so we get an understanding of what kind of spread of different types of traders we've got as subscribers on my channel. Because some of you, of course, are going to be in the unconscious incompetence. Some of you are going to be in a different area. And you're going to notice that as we go through the different areas, there are challenges that come up. So a few characteristics of the unconscious incompetent trader. Randomly opening and exiting trades without a defined trading system. That's classic 101. He changes his system on a trade-to-trade basis. So on a trade-to-trade basis, the system's getting tweaked and changed every time. So there's no control to measure against. He or she, I should say he or she, because there are happily an increasing number of lady traders coming into the game. And as we talked about in one of my last videos, they are naturally set as a predisposition to be more effective in this on balance. Sorry, gents. He does not, or she does not apply risk management or position sizing principles. In other words, if you look at the list of losing trades from somebody who is unconsciously incompetent, you'll be aware that the losing trades vary quite wildly. Now, that shouldn't really be the case with somebody that's running a detailed ultimate trading plan, because the ultimate trading plan would say, look, you aren't allowed to take more than 1 or 2% risk per trade, and therefore you would find all the losing trades to be consistent with 1 or 2%. The stage 1 unconscious incompetent trader is not going to be in that place whatsoever. You'll see they lose 5% on one trade, 10% on another, 0.5% on another, and so it's going to be quite varied. There isn't a system in place, which therefore demonstrates that the trader is controlled emotionally. They are making emotional, feeling, gut-based decisions rather than logic, following a plan in a disciplined, masterful type format. I want to delineate that and show you the differences between the two so you can really check in with yourself and ask yourself really honestly where I am in the plan. Because incorrect identification of your position in this process will not result in much benefit for you. In other words, if you don't know where you are in the plan, you don't know what you need to do next to get from maybe stage 1 to stage 2 to stage 3. You've got to figure out which one you are. Honesty is going to be critically important here. You often changes trade direction on the spot and chases price. So I'm long, oh shit, it's going up, now I'm going to go short. Oh, it's short, oh, now I'm going to go long. And we see that happen a lot. Very quickly, someone has a short bias on euro dollar based on nothing. They haven't even bothered to check the higher time frame. Maybe it's above the 200. Suddenly it starts rallying and then they jump on the other side of the trade and try and catch it all the time, paying lots of spread away and getting themselves into a fair old muddle. They get motivated by winning trades and they don't really care much about losses. Beginner's luck is the juice of the day, is what keeps them going. And often one loss, just one, can often wipe out all of the wins on a bunch of previous trades. This is indicative of somebody that's, cutting their winning trades too early and letting their losses run. So at this stage, the traders with beginner's luck are more likely to keep going and make it to the next stage. However, often traders lose money, they get easily discouraged and acknowledge that trading isn't as easy as clicking a mouse. Here it's really important to understand that you are just getting started and that not knowing a lot is totally okay. Your focus should be on learning the basics and trying not to lose too much money. The goal here is to move from stage 1 to stage 2. And stage 1 is always about realization of where you are in the stages. Stage 1 is about bringing to your conscious attention that actually you may not be running to a plan. You may be falling foul of a number of these characteristics of the unconscious incompetent trader. And until that realization set or stage sits in, and of course we realize where we are, we can't take the appropriate action to move from stage 1 to stage 2. Now, let's have a look at stage 2. So stage 2 is conscious, incompetence. So remember, if you look at the analogy with a child that's driving, this of course is not a baby anymore, not knowing they can't drive, but this is a 17-year-old who realizes, look, there is a gap between my skill set and being a competent driver. I'm trying to fill that gap by undergoing tuition, coaching, instruction with a driving instructor, and I'm consciously working on it. I'm aware I'm incompetent. So at least I have the realization phase in my mind that, yes, there's some work to do here. I've got to fill the gap. This is what we need for you to be able to go through and know which stage you're at, so you know what work to do next. When I've got you with a cracking trading plan, when we accelerate this mastery, you're going to find yourself in a completely different space. If you're somebody who's watching this right now, who's having inconsistent returns or inconsistent results, one day you're doing great, the next day you're not, you're in the unconscious incompetence phase. You don't know what you don't know. And that's a dangerous place to be, because you might think you're more competent than you are. Analysis of this that we've done over the last nearly 18 years now demonstrates that most beginners think they're way higher up the curve than where they really are at. And that's why you often get some seasoned traders who sit there and laugh at beginners and say, you don't know what you're up against yet. Well, you can go into this just foolhardy, relying on a few wins to keep you going, or you can put this structure in place. I highly suggest the latter. So what is stage 2? Well, it's conscious incompetence. We know that there's a gap. It's the stage of consciousness. This stage, should I say, of conscious incompetence is the one that usually lasts the longest. This is the learning, training, coaching, mentoring, threshold, making choices. Some traders will never leave this stage. Please be aware of that. Even after years of being involved in the markets, they spend their time just literally consuming more information. There's a few principles and questions that can make you aware of potential problems in your trading mindset and general approach would really be the following. Have I changed my trading system more than once in the last 6 months without really putting in the work? Basically what we call system hopping, and this should really be avoided. So system hopping is, I haven't really played full out. My trading plan might suggest I trade 15 to 20 positions a week. On average, I'm doing 5 or 6, haven't really thrashed the system out, haven't really embedded or trained it through, and now I'm hopping onto another system. Probability of mastery with that approach is practically zero. Am I actively reviewing my trades to find out what is going wrong? Or do I try new things all the time without dedicating myself? Am I still making impulsive trading mistakes that cost a lot of money? Or do I follow my trading rules? Do I repeat the same trading mistakes again and again? And in order for me to know that, I've got to look at what I've done in the past. I've got to introspect. I've got to go back, look at my losing trades, and do I spot a pattern? Lying to yourself will keep you trapped in the current phase and your current state, and you won't be able to improve nor evolve as a trader. So that's your stage 2. So let's now jump into stage 3, and stage 3 is the analogy with driving was of course a young man or girl having passed their driving test, and they're now 17 years old, but they've got bloody great P plates stuck on the back of their car telling everybody on the road that they are a new driver and to be treated with some caution. Well, that conscious competence says, I'm a proficient trader, I can do it, but I have to think about it. And that thinking about it is going to burn my neural activity. In other words, it's going to tire me out. This is where you constantly have to think, mirrors signal maneuver when you're in a car, or clutch in first, and then I select the gear, and oh my God, I've grinded the gears again. Well, over time, it just becomes an automated, myelinated, as Daniel Coyle put it, code that becomes encoded into your nervous system, meaning you don't have to use up too much conscious capacity to keep on path. The trader now starts to realize what trading is all about. Although trading is still not easy and the results are far from being perfect, he understands the importance, and this is key, the importance of process-orientated thinking. He stops focusing on only the outcome of his trades. Now, most traders want consistent results before they apply consistent actions, which therefore is impossible. First, you need a consistent approach, a solid routine without much deviation, and then you will have consistent results as a byproduct of that. Of course, those results won't be too impressive at first, and you'll probably keep losing for a while, but at least you have something you can work with. As I said in previous videos, you've got a control. When your actions and results are all over the place, it's impossible to identify specific things and work on them. You've got no control. So it's critically important that we have a trading plan in place first, see previous quests for that, and then we implement this process of self-mastery. Self-mastery means I'm putting routines and practices in place which ensure I move from unconscious incompetence through conscious incompetence to where we are now in this example, which is conscious competence. I know what I've got to do, but I have to think about it. To then finally, which is the place we all want to end up, which is becoming number 4, stage 4. Few people get there, which is unconscious competence. This is autopilot trader. This is mastery. This is heavy myelination. So at this stage, the trader has spent years of looking at screens, taking the same setups, hundreds or thousands of times. He knows exactly how his preferred setup looks like, and then trading becomes effectively a waiting game. He's not pushing himself emotionally into a position. At this stage, the trader has fully internalized that he can't win on every trade, and more importantly, he doesn't care about losses as long as he follows his rules. In fact, his rule set, as we learned through the trading plan work that we did, his rule set has changed from I'm a success if I make money to I am a success if I follow my plan. And then if my plan doesn't yield money, then of course I make changes to the plan. So trading is now an activity of pattern recognition, risk management, and constant self-improvement. Now, the unconscious competent trader has a thirst for self-improvement and consistently and constantly studies the market and his past trades. He evaluates the effectiveness of his method. His trading journal is now the most solid foundation of his money-making business. It is his daily routine, and he can turn to it whenever the markets throw a curveball at him. He has a strong and sensible, rooted in science-based control. And so these 4 stages of mastery are critically important. I thought I'd share something with you. How do we accelerate that? How, if we can identify, and by the way, please put in the comments right now which one you find yourself in. How can we improve that? Well, I thought I'd bring in some of the technology I've been using over the last few months. This is called the Halo Sport 2. There we go, Halo Sport 2. And you'll notice, now you might think, what the hell is this thing? Well, this has got a piece of technology in it, like a neoprene series of spikes with an electrode. You wet this in water. It's got a sponge on the inside, so it absorbs that water. It then goes in here, and then you put this on your head, like so, and then you control it with an app. And effectively, what this does is it puts your brain into what we call a neuroplastic state, which means the brain is open to sculpting, learning, and trying new neural pathways which it hasn't gone down before. The pathways that you are going down right now when you think are based on the routes that you have carved and are most consistent to going down. If you're used to your spouse, whenever they give you feedback, internalizing in your head, she's being negative or he's being negative, then you'll always look at what they're saying to you, the predisposition that they're being negative, and you'll interpret it that way. If you then had a coach, counselor, or therapist say to you, well, hold on a sec, what about if that person, when they're communicating to you in that way, really is saying that from a place of love? They'll really struggle to understand how that could have come from a positive place when they're so hell-bent and used to, so conditioned to going through and looking at everything through maybe a negative set of eyes. Now, what this technology does, and which is beautiful about it, is it does 2 things. It puts you into a neuroplastic state, about 20 minutes of what we call priming or neuropriming, setting the mind up for a routine. So I did this, I'm a magician in the Magic Circle in the UK. My family have all been magicians and so on. So I as a part of me, which I love, and it's all about the concept or the constructs of, for me, changing people's beliefs. Right, and if you can change people's belief using magic, then you can do some amazing instructions. My kids love it, and it's always been something that's been part of our family. I wanted to learn a magic routine, and I wanted to see if I could accelerate it. I used this, and boom, I got through that routine and learned a whole set of routines, which would normally take me hours to process and then integrate into me quickly. This integrates it. So I have no affiliation with this company. If you want to get yourself one of these, you just have to buy it from them direct. But it's called a Halo 2 Sport. You need to wet this. You need to prime for 20 minutes. It's a trippy experience, I'll tell you that. And then you go into a process, like for example, you'd have your trading plan, and then all you're doing is you're priming every day before you set up your trading day to put your brain into that neuroplastic state to increase the process of myelination. And you will find you will get to, as long as you're following your plan and doing the right practice, you'll get to stage 4 much faster than you ever would do by going the long road. So I hope that kind of gives you an insight into some of the latest technology. I've got to tell you now, like 10 years ago, we never had any technology
Much faster
like
than you
that.
ever
There
would.
is no excuse now, if you're somebody that's committed to this, if you're somebody that really wants to make this your primary income stream, or at least a decent second income stream, or certainly give yourself more money and choice and freedom, with solid trading plans, with this kind of wearable technology, this wearable hack technology, which can certainly accelerate you to a place of mastery where the myelination process is running at 3 to 4 times faster than normal. This can certainly help with the learning process. If there's one skill in life that you want to make sure you've got in your backpack, is accelerated learning capability. Accelerated learning capability. We all live in a world now where the world is changing so much, whether it's learning new trading system styles or progresses, or whether it's new businesses or new ways of being, we've all got to be able to adapt quickly in the world that we're in, be able to learn new skills, be able to learn new technology and implement that. It's all well and good to understand something, but to really know it means you're actually using it and implementing it. And technology like this really does accelerate and help. Every fat person on earth knows that if they ate less and exercised more, they'd be slimmer, but they don't do it. They know it, they understand it, but they don't know it. Knowing it is understanding the principle and implementing it. And if you can get any help, and I am all about finding the edge, you know, how do I find that little edge, not over somebody else, but an edge which just gets me going to where I want to know better and faster. And there is such incredible technology out there available to you today, which can help with this process. However, if you don't know where you are in those 4 stages, the probability of getting to where you want to go is reduced. So I want you to be honest right now. I want you to think about where you are, put that in the comments fields. And now you've got really a couple of options. Option 1 is you can go the long, hard way, take what I've taught you here today, have a stab at it yourself, but not really get into the process of writing a trading plan and then getting yourself on the 4 stages of mastery. Those 2 things together are game changers. If you don't go that road, you are in the road of trial and error, which I can tell you is the most expensive way, emotionally, financially, and spiritually, of learning to trade. People think, well, I won't invest my time in doing a trading plan. I won't do any trading processing or coaching. I'll just put some money in the trading account and I'll have a little punt. It is expensive emotionally, spiritually, and financially if you go that road. It's harder work to put a trading plan together. It's harder work to stimulate your brain into a neuroplastic state every day and then get yourself into a process where you're super myelinating and therefore learning these skills at a mastery level. But if you're prepared to do that, the results and the avalanches of abundance in everything comes to you by putting in that hard work. Let's figure out who you are, where you fit in this process. You know, what kind of personality profile and traits and character do you bring to the table? And if you want to know that, which I think is crucial, is going to be critical and essential to your success. So I want to make an offer to you to have access to one of my coaches completely free of charge. You'll see a link in the description field. Click that, book yourself on, and have a personality profile and figure out, okay, now I know what a trading plan looks like, the ultimate trading plan. You got that on this channel. Now let's understand, who are you in this mix, and let's figure out what starting point you are at. So make sure you see that in the description of this video. Click the link to book yourself onto what we call a trader strategy call, where you want to book maybe 30 to 45 minutes with one of my coaching team who will take you through the process to help you identify who you are. Now look, if you like this video, don't forget to hit like. If you aren't a subscriber to my channel already, get yourself on the subscription list. We'd love to have you as part of our family, part of our team. I broadcast at least 2 videos a week and at least a quest now every month. Until next time, look forward to seeing you later here in the trading day.
Steve and Dave use eToro to invest in the financial markets. Steve does research on global investment opportunities. Dave does research on how to become a level 60 wizard. Steve follows the feed for the latest market.
Today, we're talking about how not to trade Forex. 7 rules to guarantee your success. Let's start with number 1. And as you can see with the screen behind me, created just for your benefit, is a screen with multiple indicators. Now, this is the biggest mistake that people make and I can tell you now, I've been trading now for 24 years. I've been coaching and training people for over 17 years. I've had over 300,000 people across all my trading floors and trading centers around the world, which continually keep expanding with individuals who come along with their trading screens rattled up with a number of different indicators, whether they be trending indicators, oscillating indicators, range-based indicators, indicators that show changes in speed, show changes in volatility, show changes in volume. Stop. The rule of thumb is 2 is a company, 3 is a crowd, 4, you can get the door. And the point of that is that the more indicators that you put on your screen, and the reason people put more indicators on their screen is effectively what they're doing, A, is they're gambling because they're not trading with a plan, and B, what they're trying to do is to justify the fact that they're not really gambling, is they feel if they add more technical indicators to the picture, of course, they're looking more professional, and of course, they're giving themselves a greater probability or prospect of success. Look, the reality is this. If you are putting 4, 5, 6, 7 different indicators, the probability of those indicators correlating or cross-correlating suddenly becomes lower than a snake's belly. The reality is that if you have too many indicators in your time frame reference of window, you're going to have mixed signals, and we all know the confused mind does not trade successfully. So the real rule of thumb here is 2 is preferable, 3 is really max. So as you can see on this euro sterling, we've got some pivot lines here. Now, pivot lines are really great for showing you where the top of the market is, where the bottom of the market is, where the floor and where the ceiling of the market is. When you're using an indicator like pivots, you really need no other indicator, maybe a MACD indicator to show you some overbought or oversold zones, or whether there's buying or selling in control at this time. So a nice conformational indicator for pivots would be a MACD, but what I've done here is I've put a number of indicators. I've got volatility indicators, RSI, I've got Williams accumulation distribution indicator, I've got average true range, and I've even managed to put on here an equivalent of a Bollinger Band. So the reality is too much of a good thing is not a good thing. We want to restrict ourselves to 3 indicators max. If you're wondering which indicators should be placed on which trades at which time, your first rule of thumb there is to recognize, am I in a trending market, and therefore I should only be using trending indicators? Am I in a range-bound market where I should then be using range-bound indicators? Range-bound indicators are those which test the higher and lower variables, such as pivot points, such as Donchian channels, such as Bollinger Bands. Trend-based indicators are, of course, your classic moving averages, your MACDs, your MACDs, which is moving average, convergence, divergence indicators, and a whole variety that are all available for training in smart charts, of course. So let's keep them non-mixed. This is a big mixed bag here to show you what a mixed bag looks like. We don't want to do that. Make sure you know, first of all, up front, whether the market's trending or whether the market is ranging, and then apply the correct indicators. Now, the best thing you can do if you want to cross-correlate is to look at higher time frames. So if you're trading the 1 hour chart, a really good idea is to look at the 4 hour chart or even the daily chart. If you're trading the daily chart, looking higher than the daily chart to the weekly chart can be a mistake. And the reason for that is a trade that, when you're looking at a cross correlation to weekly chart, is really a trade that's going to run many weeks. Many of you are not going to want to be in trades that run for many weeks, of course, because the longer you are in these positions, when you're using leveraged instruments, are going to be paying more for the trade the longer it's in. Remember, if you're in the UK citizen right now, you're going to be paying a spread betting charge to be in your positions overnight. It's called an overnight financing rate. You want to keep that to a minimum so you can be in a position, get the trade right, and then exit the position. So for those of you that are trading 1 hour charts or trading half hour charts or 15-minute charts, we just click up to the higher time frame. If it's a trending condition, we look at trending indicators. If it's not, if it's a range bound, we use range bound indicators. Look at the higher time frame or even a lower time frame to get some entry correlation. Higher time frame normally for the direction, lower time frame for more of an elegant entry. If you want to time your entry even better than your current time frame, look at the lower time frame to give you a better entry. Look at the higher time frame for the bigger picture. What looks short on a very short time frame can actually be part of a much larger, longer cycle. And therefore, if we look at the physiology from phase 1 to phase 2 in that higher time frame, we've got a much better picture than just throwing hundreds of indicators on a chart. So that's your first step. Number two, what not to do in the currency markets is trading off emotions. Now, you know if you're trading off emotion because you've got no real rationale to be in the trade, number one. You're not trading consistent with a trading plan, number two. And three is you can't wait to get in the trade. Now, if you can't wait to get in the trade, the reality will probably unravel that you can't wait to get out of that trade, because a trade rushed in is often a trade you can't wait to get out of. So trading off emotions is really critically important. A good way to understand if you are trading off emotions is to start by planning a trading plan, which defines what trades you're trading, when you're trading those trades, what positions you're in. A really good rule of thumb is the 5-3-1 rule. We trade mostly 5 currency pairs. Now, that's not to say we won't trade outside of those 5 currency pairs, but we trade 5 currency pairs because we want an intimate understanding of how those currency pairs move. We use 3 different trading strategies that we become intimately involved with, and we trade at the same time of day. So we know what markets are doing at those same, you've got the same participants trading the market at the same time of day. By adhering to the 5-3-1, we're not trading from emotions, we're not rushing in. You should take, as a beginner, you should take at least 5 minutes per trade to plan your trade, to make sure that that you're asking the power of negative questions. So you're asking yourself, not how much, what should I spend my money on when this trade goes well, but you should be asking yourself the question, why will this trade not work out? Why am I completely out of my mind placing this trade? What is the stupid idea I've got? And why the hell do I think I'm going to make money on this? You've got to be the person that asks yourself the tough questions, because nobody else will be sat there asking those questions to you when you're placing the trade. You'll be gung-ho, you'll be placing the trade quickly outside of trading a plan. That tells you emotions are involved. And then, of course, the person that will be sat with you when the trade goes wrong is probably your spouse, telling you what an idiot you are for placing a trade too quickly without due consideration and without planning it properly. So number 2, don't trade off emotions. Trade from your plan so you know what you're doing and when you're doing it. Okay, so step 3, how not to trade. Look, you've got to stick yourself to a trading plan. That's critically important. But most importantly is to not then switch away from that plan when things go wrong. You've got to give yourself some bedding in time. What do I mean by bedding in time? Any plan that you try and run the first few weeks through will be brand new to you, and there's an adjustment period of time. You know, it takes the brain a little while to just embed some principles, some tools. They say it takes up to 21 days to embed a new set of principles, a new set of rules. You know, our brains are configured to follow a set of rules when they fit inside our central nervous system, when they're controlled by our unconscious part of our brain, when we aren't have to think too much about it. When we're having to think too much about it, we're conscious. And when we're conscious, we have to work hard. And when we have to work hard, we're under stress. And we're under stress and the markets are moving against you, you're going to pop. So the reality is you've got to give yourself a bedding in time, and that should be part of the trading plan itself. So what people tend to do is they'll take on a trading strategy that is unknown to them. They'll start trading the position. It'll go well for a few days. Then they'll find that they'll lose on a few positions. Then there'll be 2 or 3 days out of bed and they'll think, oh my God, the plan's wrong, the strategy's wrong. And then they'll change it. And what they do is they spend their time hopping from horse to horse to horse. There's an old trading strategist called Bob Schmeichel. And Bob Schmeichel's rule of thumb was get in line and stay in line. Now, get in line and stay in line means, you know, imagine you're at the airport and you're queuing up with your luggage to get to your destination. Your plane's taking off pretty soon and you're watching all the lines. You stand in one line, then you think, well, hold on a sec. My line's not moving quickly enough. So you hop from one line and you get to another line. And then you look back at the line you're in, you realize that's now got through, they've checked in, and now I move lines again. So what I'm ending up doing is I'm switching my position from line to line. I'm jumping horses from time to time, and I'm not giving one line long enough to bed in and yield me results. So this is a really important principle. Step number 3 is give yourself a minimum, and the rule of thumb here is 21 days. And that means consistent. These are not including weekends, these are trading days. So we're really looking at over a month in time. So at least, 5 weeks in total, right? So you've got a 5-day trading week. Many of us traders trade Monday to Thursday. We don't normally place positions on a Friday because we don't want to run into the weekend rumble. So we let it go from months of 16 days as a month, another 4 days into your next month. It gets you close to 20, 21 days. Then you can say that your trading plan has been bedded in. If we hop from horse to horse too quickly, we're going to run ourselves into problem. That's something you really don't want to do. Also make sure that part of your trading plan includes positions you understand. So trade, the principle here is trade what you know. Don't trade things you don't know. Now, obviously that means, back to my 5-3-1 analogy, we trade 5 positions, we trade 3 strategies, and we trade pretty much the same time of day. And the reason we do that is because we want to achieve a level of mastery. Mastery is when our unconscious brain can place the positions without our conscious brain having to think about it. Consider when you drive to work every day. You probably drive the same day, you probably do the same thing every day. We are creatures of habit, and you've probably maybe had this happen to you whereby on a Friday you drove to work, and let's say by chance you need to use your car on Saturday and you're going down the same road that leads to where you work. You'll probably find yourself driving to work unconsciously and then realizing, oh my God, you know, I've got myself off path here and I now need to engage my conscious brain, because we are creatures of habit. So harness that, because what that means is that if you use the same strategies on the same currencies at the same time of day, and you're going to load that into your unconscious brain. And there's a reason for having an unconscious brain. It means that we can perform multiple calculations, multiple routines and systems and strategies without having to engage our conscious brain. That frees our conscious brain up to notice if things are going wrong. So bedding strategies in, giving it 21 days to really sit with us so it loads into the unconscious part of our brain, frees up the conscious part of our brain to spot if there are any uncharacteristic, anything's problematic with the trading activity that we're doing, and allows us to get better, sharper, more profitable, and ultimately more successful. I hope you've enjoyed this video. If you liked it, hit like. If you haven't subscribed already, get yourself on that subscribe list. And we look forward to speaking to you, talking to you, and training you from my trading den here in the UK in future sessions. Okay guys, step 4 on how not to trade Forex. Look, this is a biggie, so real listen up on this one. Do not trade around news events. Now this is a really, really important one, particularly for you beginners out there, because you probably aren't aware of the impact that economic news and calendared economic news has on the currency markets. When big news announcements comes out, volatility moves crazy. Now if you don't know what volatility is, it's price range movement over a set given period of time. The problem with that is, of course, if you've got a stop loss in and you've entered a position, you can get stopped out of your trade very easily and take a very quick loss where you needn't had to at all. So it's really important that you understand when news is coming, when it's predicted. Now, if you're somebody out there who doesn't use smart charts and you're somebody just starting out and you want access to free news, there are lots of fantastic economic calendars out there where you can access your news. I'm just going to pull up one right now. This is one of my favorites that I used for many, many years before I built my own trading platform. This is FX Dailies. You just click on the economic calendar. I'm going to kind of just show you how you get to that. This is Daily FX. So for those of you that are watching, dailyfx.com is a great news site you can go to. Click on calendars over here and then economic calendar. And then what it will do is it'll jump to the day. And it'll show you the currency, and then it'll show you what news is coming out, if it's high, medium, or low based news. It'll show you what the actual is, what the forecast, and what the previous is. It's really important to be aware when there's an important news announcement coming out, because it will disrupt your trade. So look, you need to think of trading like sailing. You know, if you're somebody out there who's ever sailed a small boat before, you'll know there are certain days you can go, you've got great wind, you can go out, you can have a great tour around a lake, come back in, stick your boat in the boat shed, you've had a great day. Other days you've got a forced, 10 gale wind out there. You certainly don't want to be taking a small laser boat out there, because you will capsize it. There are days to sail where the weather's perfect, and there are other days where it's not. How that correlates to the currency trading world is there are days when there are certain big news announcements. Like, for example, you've got FOMC meetings, you've got non-farm payroll numbers. There are certain days in the month where we know those big news announcements are coming, and we don't trade those currencies at those times. So you can get yourself a news or an economic calendar you can download or you can access online. Better yet though, if you're a smart charts user, we kind of did the thinking for you there already. So I'm going to show you how we show you where the news is and what the impact of that news is directly in smart charts. So let me just jump over to smart charts right now and I'll show you. I've got a chart here of the British pound against the US dollar. This is cable. I've got nothing on this chart. I kept it really vanilla, nice and clean. How do I know if there's a news announcement coming? Well, of course, I could do what I've just told you to do. I could go and look at economic calendar. I can go and see what news announcements are coming. I could try and figure out what the impact is. But better yet, in smart charts, if I click on the eye icon on the far right, it will tell me, first of all, what trading time zone I'm currently in. So you can see I'm in nylon right now, which is between New York and London. That means that New York is currently trading and London is trading. Now, you may wonder why that's important. Well, first of all, if you consider there are three major time zones. There's the Asian time zone, which encompasses Australasia and Asia. There's EMEA, which is Europe, Middle East and Africa. And then you've got North America. If you consider, and this is not true, but if you consider 33% is in Asia, 33% is in Europe, Middle East and Africa, and 33% is in North America. It's not evenly divided like that. But when you've got two trading sessions, trading at the same time. Remember, the currency markets trades 24 hours a day, 5 days a week. When you've got two trading sessions, like all of North America and all of Europe, Middle East and Africa trading at the same time, which is right now, if you look at that picture, that line says New York is trading, London is trading, Tokyo, Sydney. Okay, so the Asian markets are fast asleep. But right now you've got two time zones. That means you've got a good 60% of the currency market accessing and actively participating in the market. Volumes will be higher. There'll be a lot more activity. Volatility is likely to increase during this period of time. And certainly if positions come on with big news announcements on the British pound against the US dollar, now you've got two constituent currencies from both regions which are active in the market. There's likely to be an impact if there's a news release coming. So Smart Charts tells you which news announcements are coming at what time. So it tells you what's lined up. You can certainly access that here. But better than that, if I close down that window, so I now know I'm in nylon, I'm here between these two time zones. So I know I've got 60% of the market is in play. But with notwithstanding that, I can close this window down and then I can go to my settings button. That's the top right middle button, settings here. I'll bring up a window and then I can click trading. And if you notice where I go to news category, if I hit high impact news and I hit medium impact news and I then close that window, it will show high impact and medium impact news directly on the chart. So if I then hover my mouse over those there, I can click on those high impact news and it'll tell me, okay, this is UK parliamentary vote on Brexit. So it'll tell me that's coming out. The news, as you can see, is in 39 minutes, nearly exactly, which means that I know this piece of news is going to have an impact in the market. Now, if I look at previous news announcements, look here. If I click on the previous one, this is gross domestic product annualized from the US. With the previous number was 2.1, the forecast was 2.1, the actual was 2.1. So it pretty much met expectations. Not much happens, we can certainly see on the chart, and things carried on as normal. Now, we do know within the next 39 minutes, I'm literally looking at an hourly chart on the Great British Pound against the US dollar. If I stretch this out, we can see when we get to this red line, which is down the middle of the chart here, a news announcement's coming. So if I'm trading a position, I need to be aware of that. I know that is medium, and there's medium and high risk news there. I might not want to be trading the market at that particular time. So really important to know when there's news coming out. You can predict that because it's all laid out in a calendar. If you can't be bothered to go and read a calendar and then plot it on your own chart, grab yourself a copy of Smart Charts. It plumbs the news directly. In fact, from what I know, Smart Charts, other than Bloomberg, is one of the only platforms which integrates news live, so fundamental news and calendared news live into the technical chart of Smart Charts to show you as the trader what's coming up so you don't get yourself into trouble. How not to trade Forex? Step number 5, and that is gambling. Now, what is gambling? Well, gambling is trading without a plan, without a risk management plan, and without a position plan. It means impulsively trading based on gut. Now, we know straight off the bat, those people who are trading off gut show signs. Success leaves clues, gamblers leave clues. Let me show you the biggest gambling clue you can come up with. Having trained literally thousands of brokers and traders across the planet in all sorts of professional institutions, there's a wall which shows all of the trades coming in for a number of traders, whether they're long, whether they're short, where the positions are. Here's a telltale sign of a gambler. Gamblers tend to go long, which means they'll buy a position and then they'll sell that same position multiple times within the same trading session. That's a clear indication there is gambling afoot. Why is that? Well, because your trading plan should have a bias. The trading plan should have a bias for whether you're long an instrument, whether you're short an instrument. There should be more factors than just buying something willy-nilly. Those that are buying a position and that position then fails, grounds out, tend to jump on the other side because they've emotionally linked in their brain. There is a correlation between the losing trade they've just taken and the next one they're going to place. They're effectively trying to win the money back that they've just lost. There is no connection between those two trades in the real world. The only connection is within the individual's world. The only problem is the person sitting in the seat. And so those that are then trading short of positions they've just gone long have effectively found in their mind this rationale which says, well, I thought the position was going to go long. It's now shorted and gone in the opposite direction. I've got to get onto that side of the trade. And of course, as they do that, like I've said before, they're a chapter behind. So they've tried to go long on a position which has now gone short. They then try and go short on a position which was originally long, and then it bounces and then it rallies in the opposite direction. I've seen traders lose 6 times on the same currency pair in a row in the same trading session because they're trading outside of their plan. They're trading in multiple directions on the same asset class within the same trading session. They don't have a position risk management plan. Now, your position risk management plan should get smaller the more you lose and should get larger the more you make. Have a think about that for a second. If I take a risk managed approach which says that I risk 2% of my account on any individual trade I place. If I had a room full of 50 traders and we gave them all $100,000 each to trade over a period of, say, 3 weeks, ask yourself this question. If we were going to hire a trader to trade one of our funds off the back of 3 weeks, we probably wouldn't do that. But let's say we decided to do that for a fun experiment. Well, which trader would we select? Would it be the one that made the most money, for example? Many people think it would be the one that made the most money, but it really wouldn't. There's a 2-step to this. The first step is we look at all of the traders losing trades. This is the first most important step. If we said that we mustn't lose more than 2% on any trade that we place, that means, let's say, for example, they have $10,000 in a trading account. That means they can lose up to $200 or £200 on any individual trade, but no more, which means that the trade risk management plan has to account for whatever 2% of the account is right now can be staked at risk and no more. Now, notwithstanding slippage or notwithstanding a gap, notwithstanding normal trading conditions, that account should not lose more than 2% of the current balance. So the first thing I would do across that whole group of 50 traders would be to completely ignore their winning trades and look closely at their losing trades. Now, if their losing trades equated to more than 2% of their account balance at that time, I know they're making an emotional gambling-based decision on how they feel about the position, and they're increasing their trade risk management based on circumstances, based on gut feel, certainly outside of their trading plan, which clearly states no more than 2% should be risked on that trade. So the first thing to do is look at those 50 people and pull out everybody who risks more than 2% on the trade, because we'll see the losing amount, all of their losing trades. You just look at their losing trades compared to their account balance at the time, divide one into the other, and you'll see very quickly if they're risking more than 2%. All of those individuals that have risked more than 2% on a handful of trades, they get thrown in the bin. They are no longer part of the game because they can't be trusted, they can't stick to a trade risk management plan, and they're allowing their emotions, their feeling, to get involved to make them feel that they can place more on the position than their trading plan dictates. So that's the first deletion that we do. Then whoever we're left with over that period of time, we look at who's made the most money, who's traded most consistently to the plan. Those are the people which are then bubble sort to the top, and they're your top traders. So we start, first of all, by deleting the people with the bad behavior. Remember, the vast majority of people that come to this sport and lose predominantly because they can't handle their emotions, they can't handle their mindset, they can't stick to a routine, and they cannot stick to a plan. They trade emotionally, they bend the rules too far, and the only rule you cannot afford to flex is the trade risk management and the position risk management of the trading plan. If you break those rules, you end up in the bin. If you don't break those rules, you end up on the table, which is then sorted from those who have made the most money and have stuck most consistently with their plan. The most important thing you can do in this game of trading is to stick to your position risk management plan. Markets can go with you and markets can go against you. That you cannot control. The one thing you can control is what you do about it when that happens and what you've done about it before that happens. If you've exposed yourself to too much risk beyond your trading plan, you don't get to count yourself in the winning team. Okay guys, how not to trade Forex, step number 6. Step number 6 is all about the search for the Holy Grail. Now, most traders that come into this game think they're going to find that one trading strategy that butters their bread for the rest of their life. Sadly, that is simply not true. Trading strategies do change over time, so do market conditions, so do participants, so does volume, so does volatility, so does price range movement, so does many factors. It is clinically impossible, he says, touching wood, that you can open a black box system that will self-correct itself to the market. We do need human intervention. So there's a few steps you can do to make sure you don't fall foul of searching for the Holy Grail and wasting your money in the process. Make sure, step 1, that you always back test and forward test your current trading strategies. Now listen, strategies do change over time. Sorry, market conditions change over time. Strategies tend to stay the same unless they're updated by human intervention. Your best bet is to have a grey box system whereby you're using real-time trading strategies, but with human intervention. So that's the difference between a grey box and a black box. You need to be flexible in your approach, meaning that you test your trading strategies, you back test them, you forward test them, but you should know your market condition and what your strategy is looking for. Is the strategy you're trading? And for some of you that have already seen some of my videos, and if you haven't, look at my YouTube channel. If you haven't subscribed below or you haven't liked this video, make sure you do subscribe, and then you can see my videos where I'm showing you which strategies you should use for long conditions, short conditions, trending conditions, and ranging conditions. So ranging conditions, remember that markets trend for less than 40% of the time. People think markets are always trending. They're not. 60% of the time, markets are kind of flat, doing very little, just moving sideways. There are certain trading strategies you should use for those conditions. There are certain trading strategies you should use for trending, uptrending, and downtrending conditions. If you don't know which ones they are, make sure you subscribe to this channel, get yourself to my then channel page, and then go and have a look at the strategies where I outline which strategies work in which conditions. You should really make yourself aware of that, because trying to search for, the Holy Grail is going to be a big mistake, because nothing really fits the market all of the time, because market conditions change. Final tip on searching for the Holy Grail: don't search for the Holy Grail, search for a professional trader. In other words, consult professional traders who live and breathe trading on a daily basis, because they will know which trading strategies are working in current market conditions, which ones aren't. If you'd like help with that at all, please leave a comment underneath this video and we'll hook you up with one of our professional trading team who can give you some advice, free of charge, of course. If you really just want to know what's happening, what's working in current market conditions, we're here for you. We obviously have programs you can attend should you want to do that. But most importantly, if you want to know just what's working right now, leave a comment below and one of the team will jump on and we'll help you out. But forget the search for the Holy Grail. So the only time you should be looking for the Holy Grail is when you look for Monty Python's Holy Grail, which I've got to tell you is one of the most funniest films of all time. If you haven't seen that film, do check it out. I never even heard of that film. What? Search for the Holy Grail? Oh my God, you haven't seen the Search for the Holy Grail?
Tis but a scratch. A scratch?
It's John Cleese and all the guys that did Spam-A-Lot.
Victory is mine. We thank thee, Lord, that in thy mercy... Come on, then.
It's amazing. It's brilliant. Final one now on how not to trade Forex. Point number 7, not honoring stops and limits. Now, this is really, really important. Many traders know that when markets move against them a little bit, if they would just move their stop loss a little bit and give themselves some wiggle room, they potentially wouldn't get stopped out. Big mistake. And here's why that's a big mistake, for 2 reasons. Number 1, the risk that you're placing on the trade is calculated from your entry price to your stop loss. That risk should be used to then calculate your position size. So your position size should be derived from, let's say, for example, you're taking a 2% risk management across your account, which means every trade you place, you should not be risking more than 2%. Well, 2% of, let's say, a $10,000 account is 200. Let's say you have a 10 pip stop, which means that 10 pips is the ultimate risk on your trade, right? You take the 200, you divide it by 10, and you'll know that 10 goes into 200 20 times. So your trade size, therefore, would be £20 a point. Now, by moving your stop loss, let's say another 10 points south to give yourself some wiggle room, effectively what you've just done is you have doubled the risk on that trade. You've gone now from £200 risk to £400 risk. You've gone from 2% risk to 4% because you can't adjust the trade size once you've placed it. You are running at a risk of £20 a point. You can obviously sell a bit back to reduce your trade risk management, but you are then crystallizing a loss. So the trade risk management piece, where you place that stop loss, must be agreed up front and not moved around after the trade's in play. That will guarantee you're going to take unending and spiraling losses. Remember, the trader who doesn't know how much he's going to lose by the end of the trade is the trader that burns himself at the stake. You should always be aware of exactly what your risk profile is on the trade. That calculation should be done up front, and those stops and limits should not be altered. Unless you are blending in or blending out of a trade. That's where you add more or take less away from a position, which we can cover in more of a future advanced training session with you. I will make a note to add that as a video onto this session, or onto this channel, should I say. But in the meantime, you want to make sure that your stops and limits are honored. If I can tell you this, they say Rome wasn't built in a day, but certainly could be destroyed in one day. And most people's trading accounts can do fabulously well, sticking to their risk management plan, trading to their strategies, and over a period of a year can make fantastic returns. They can destroy it in one day. And the way they do that is by moving their stops and limits around, because the market is moving around quickly and they haven't done enough analysis up front, they haven't trade risk managed up front, and they keep moving their stop loss down. As they do that, with the current trade risk management in place, the losses are unending and can spiral crazily out of control. Remember, if you lose 50% of your account, you now need to make 100% of where you are just to get back to where you were. That's worth thinking about. The beauty in this game is all about trade risk management, and by moving those stops and limits after the fact is going to get you into trouble. Hope you've enjoyed this video. If you liked it, hit like. If you haven't subscribed already, get yourself on that subscribe list, and we look forward to speaking to you, talking to you, and training you from my trading den here in the UK in future sessions. Today is the day I teach you my #1 trading strategy for beginner Forex traders, known as the trend wave. Now, the trend wave is one of the most powerful trading strategies you can use, and we're going to teach you right here, right now. Okay, so let's take a look at the trend wave. Now, this is regarded as my #1 trading strategy for beginner traders. This really gets you into the game. If you know nothing about currency trading, if this is really your first time and you want to understand, why, if you've never been trained professionally before, that you're placing trades and then all of a sudden you realize you thought the trade was going to go up, it suddenly falls, and then you think it's going to go down and then it goes up. That's because markets move in two things. They move in phases and they move in cycles. So what I'm going to do with you today is I'm going to take you into smart charts. You can see smart charts is literally all around me. I'm engulfed in smart charts. So we have an electronic whiteboard running smart charts in real time that you can see behind me. This is a strategy for beginners. So if you don't understand cyclicity, if you don't understand the phase 1, phase 2 of the currency markets, this is going to be really important training for you. So I thought what I would do is start you off with that straight off the bat. So let's go straight into smart charts. If you look top left of the screen, we've got the learn icon. So we click on that and it takes us into the mix, which shows us all of the training modules. Now the training module I really care about this time is decision. So this is where I'm picking the different trading strategies. Now you can see, if you look behind me here, you can see the 180 phase changer. This is the one we're going to look at today. It's the T wave or the trend wave. So just click on that and it brings me straight into the strategy. Now, obviously I'm going to start from the beginning. And I'm going to give you a good rundown so you have a good understanding of what a trend wave strategy is. It works on the phase 1, phase 2 methodology, which means markets, and I want you to think about this, markets don't move up forever and they don't move down forever. Markets move in phases or in cycles. Very much in nature, like animals breathe in and breathe out, markets breathe in and they breathe out. So we call the phase 1 the breathing in and the phase 2 the breathing out. And these give us distinct buy points and they give us distinct sell points when a pattern has established itself. So what you're going to love about this strategy is it uses a very clever price configuration called a low test or a high test. And what that really shows you is after a period of selling or a phase of selling, there's a quite special indication of a price bar which is exhausted, meaning it's really sold off. And then after the selling has ended, halfway through the bar, you'll see buyers come back in. And that's signified in a particular pattern, which I'm now going to show you. And that therefore shows you that the selling period is over and the imminent buying phase is about to restart. That phase 1 cycle is about to start off again. And that is our buy point. Putting a stop loss underneath that exhaustion area is key. It keeps our risk very low. It also protects us from any downside risk. But what's most importantly, it gets us right in the phase of the cycle at the right point, which means you can enjoy, most importantly, maximum profit upside with as minimal risk. Now, these are the basic tools of some of the best traders in the world. Not understanding phases in cycles is crazy. So this training, if you're a brand new beginner, or even if you're somebody who's been trading maybe for a few years, but you kind of have hit and miss results, this will expose to you why you have hit and miss results. This will show you exactly where the exhaustion is, how to identify when buyers have re-entered the market, and really give you a good entry point. So let's dive into the training right now, and then we're going to go right into the position. We're going to go right into the market today and see what Smart Charts has actually found in terms of trading opportunities which best match the T-wave, or as we know it, the trend wave trading strategy. And then we'll look to get a trade on, see if we can't make some money. Okay, here we go. Let's start with the basic conditions for a long setup. To identify an uptrend, we would like to see at least one higher high and one higher low cycle on the time frame we are trading. Ideally, we would also like to see this cycle formation form within a higher high and higher low of the time frame above by using multiple time frame analysis. Whilst this part of the analysis is done at your own discretion, Smart Charts identifies the following conditions. For a long setup, the strategy requires the 8-period moving average to be above the 20-period moving average as further confirmation of a bullish trend. There should be a low test bar, which is a bar that rejects the downside push and closes near to where it opened, in the upper half of the bar. The entry price would be 1 pip above the high of the low test bar, with a stop loss 1 pip below the low of the low test bar, and a target level of a 1-to-1 reward to risk. These are the strategy defaults. Your order will be placed as a no expiry order. This means this will stay as a pending trade until you cancel it manually, or the trade is triggered by reaching your entry price. If a new seller's bar goes on to form without triggering the entry level, then we can simply cancel the order as the buying momentum we were forecasting hasn't presented itself. If the new seller's bar forms into another low test bar, it will generate another signal and we can refresh our trade and possibly buy at a better price. Okay, so we've looked at the trend wave long setup where we can certainly see where we enter, where we place our stop loss, which is 1 pip below that low test bar. That bar signifies that the selling's dried up, new buying pressure has come back in. We want to grab a hold of that if the next bar breaks above it. So now let's have a look at using Smart Charts to do the scanning work for us. Remember, we can spend all of our time scanning ourselves, but that really is a waste of time for a trader. Our time best spent is analyzing the trades that Smart Charts shows us and then managing those trades ourselves. So what we now do is we take a look back at the Smart Chart screen and we click on charts. That's the next icon along from the learning area. And that'll bring up my 4-screen layout. Now, the reason I look at 4 screens simultaneously is I can run different strategies on different screens, and I can look at all sorts of things simultaneously. I can also run lots of monitors behind me, which are also looking at other screens. But effectively, you don't really even need more than one monitor to place a trend wave, or any of the strategies for that matter. We can split the screen into 4. What I've done in the top left-hand corner is I've left this as a no strategy screen, meaning there's literally no indicators running on it. It is literally a vanilla trading screen. I've done that for a reason. I want to make it really simple for you to understand how we start from the very beginning, how we find a trend wave, how we can put it on, and really keep this as little confusing or as less confusing as possible. Remember this, the confused mind doesn't trade, doesn't make decisions well, and gets kind of caught in a real frozen state of decision making. So let's keep things simple, and let's add the layers on top. So if we look at the left hand side of the screen, top left here, I'm going to click this middle icon, which is a square with 2 arrows in opposite directions, which means that's going to expand that screen out, as I've now done. It's defaulted to looking at the Australian dollar against the Kiwi dollar. So now we need to find that trend wave strategy, which will run against all of the currencies and, interestingly, all the other asset classes in smart charts by clicking on the top right icon here, which says no strategy, because right now we are running no strategy. So we click on that and it opens the strategy finder or the strategy scanner, and you'll see fourth column along is the trend wave. Now the currencies which are glowing white are the ones where Smart Charts has done the analytics in the background, has found a number of currencies or indices or other asset classes, perhaps commodities. In this case, you can see there's everything from gold and platinum to some of the major indices, but right at the top, which is where our core focus is, of course, as for Forex traders, are the currencies which best match the trend wave strategy. Now I'm going to focus predominantly on long setups. That means buying setups, because that's what you've literally just done some training with me on. So I'm going to look here at the New Zealand dollar against the Swiss franc. I'm going to start there and click on that, and you'll see, of course, it brings the screen up in good detail. Now here's what I want you to really focus on. If we look at the New Zealand dollar against the Swiss franc, we can see the following. We can certainly see the phase 1, the phase 2, the phase 1, then this here is the phase 2. You'll notice that it does seem to have good interaction with those moving averages. Now, you remember the rules where the yellow period moving average needs to be above the blue. That's the 8 above the 20. Now, the reason for that is, just as a quick reminder, is it tells us that we are in an uptrend. If the shorter period moving average, like if we look at the average of price over effectively the last week, 8 periods, against over the last 3 weeks, it means that more recent pricing data is obviously higher, hence why that line is above, the yellow line is above the blue line. That means we're in an uptrend. That's our signal, or that is our clearly defined way of telling us we are in an uptrend. So obviously we're looking to buy in an uptrend, but only after the market's topped out and has fallen a little bit. Looking at the screen, we can see, look, this is the market topping out here. It's now fallen back here. And this area here where there's a blue arrow indicated tells us this is exactly where we should be looking to place our trend wave. Now, if I change my arrow to my grab tool, which means I can grab the screen down, I can now extend it a little bit to really focus on this. You can see this in much better, much clearer detail. We can see here's the arrow. So the arrow says this is the bar. Now, if the stop loss would be on the red spot, the entry will be on the blue spot, and of course the green spot is the take profit. So where the current price is right now is where this line is. So when this line crosses where this blue spot is, which would be the entry price, the stop loss is 1 pip below this low of the previous bar, which is here. We'd place the bar here, and then we'd look to take the profit here. Now, I like this trade for a number of reasons. First of all, if I was to look at the average true range, which is how much this market is moving around, this is well inside the average true range over the last 10 periods. That's really important. That means that the probability of this trade stopping out is is reduced. It means that the potential of it hitting its profit target is strong. This market has traded all in this area before. So what we're really doing is we're nipping in. We're grabbing, as this market's now sold off in its phase 2 and it's now resumed. You can see this low test. If you look at this low test here, you've got the open here. The market fell down here. Now the market's closed up here. This tail or this low test is a fantastic indicator that this selling from this phase 2 movement is now over, and we're now looking to resume back into that phase 1 where we now move the market back up for another higher high. So this is that wonderful pinnacle time. It's also important to notice that the stop would go just underneath that 20-period moving average. That does give it some protection from some downside risk. You can notice that the market has bounced off that stop loss previously. We're entering here, which we'll see what the pricing is. I don't even need to guess what the pricing is. This is the magic of smart charts, and here it really comes. All I need now do, and for you as a beginner, this is where it gets quite exciting. Because you know the system's done the analytics for you. You know the system has looked at all the currency pairs which are moving in all different directions simultaneously and has found the ones that match this criteria or this strategy criteria the closest. It's bubble sorted them to the top of the list. And then if you're still confused, you'll notice there's a red button which indicates selling or going short. There's a green button which indicates going long. You'll notice if you look closely, the one that is glowing on and off is the green button, which effectively tells you should be looking to go long on the Kiwi dollar against the Swiss francs. That's the NZD/CHF. That's the New Zealand dollar against the Swiss franc. So simply by clicking on that green button, you'll then notice the right-hand side of the screen now changes. And this gives us a trade ticket. And that trade ticket says you're looking at the trend wave. We can change our risk, so we can do pounds per point, lot size or cash amount. It's one of the beauties of Smart Charts version 2, which we are looking at right now. It allows us to risk in a variety of different ways. We can risk by the amount of money we place on the trade. We can risk by a percentage or a lot size or a cash amount. That's really clever. So some of us who just like to use a cash amount, some of us like to use lot size, and some of us just like to keep it to percentage risk. So in this instance, I'm going to change the percentage here to 2% risk, which means that I'm not going to risk any more than 2% of my trading account. If I look at my take profit, so if I now move over to the chart, you'll see if I click on any of these, I can move these up or down. So it said on that green spot, it tells me straight away I'm going to make 30 pips. If I enter here on the green line, which would be my buy entry, I would make 30 pips, which would give me a profit of 5,833. That's a nice profit. It's inside this range of price movement, so the probability is pretty good. You can see we've had low tests here, so the market is reacting off the end of that phase 2. It wants to move higher. My stop loss, of course, is 30 pips below, so that would take me a loss of about 5,900. So it's a 1-to-1 reward risk, meaning I'm risking the same amount, about 30 pips, to make 30 pips. Obviously, the edge is the strategy, which is it's the end of phase 2, and you can see buyers have already started moving back into the market. In fact, you can probably see this red bar just flick to green, so the buying pressure is coming back in. Now, we won't enter this position until the closing price or the latest price of this bar has crossed through this green line, which is indicative of this blue spot, which is the buy entry. So knowing that we're entering at 0.6496 would be our buy entry. Our stop loss is 0.6439, which means the system has already calculated where I need to enter, where I need to place my stop loss, where I need to take my profit target. All I really need to do now is I can use my professional trading skill to tell me, do I need to make any amendments to this trade? And I really don't need to make any amendments to this. This is pretty vanilla. It's pretty much straight off the bat. I just need to hit the green button now. It says, do you wish to use reduced risk? I do. So I hit confirm. And that position is now effectively on. We haven't entered the trade. That's an important distinction to be aware of. It's not live in the market right now. Interestingly, if you look at the screen, that bar has just moved into green, which means that the buying pressure is coming in. So already I'm catching this just as the buying pressure is moving. And I'm only trying to make 30 pips, but it'll make me £5,000 to £5,000. So it's worth it as a trade. So that is pretty much how the trend wave works. We've placed the trade. The system is now managing that position. So if I go to my trades screen, and I can look at pending, that T-wave strategy is in my pending screen. If I click on that, it says, look, it's on the daily time frame. It's Kiwi, New Zealand dollar against the Swiss franc. It's a buy stop. It shows me my entry price. It shows me my stop loss, shows me my take profit. I can cancel this trade if I want. I'm not going to do that. Obviously, I'm going to let this position run. It is in the system. It meets the criteria perfectly. We are literally 4 or 5 points away from entering the position. When we're entered, we are long, and the position will be managed by smart charts until it takes profit on that blue line. Okay, so that's the trend wave strategy. If you enjoyed this video, don't forget to hit the like button. If you haven't subscribed already, make sure you do that, and I look forward to seeing you in the next video. Today we are doing session 1 of live trading with Greg Secker. What I'm going to be doing is showing you how I use the strategies embedded within smart charts. So today, and ideally, it is 180 phase changer time. So 180 phase changer is a trading strategy. Now, one of the beauties of smart charts is it shows you precisely how the strategy works, which I'm now going to show you on my screen. So you get a real good understanding of what the strategy is all about. Then I'm going to flip into smart charts, which actually I'm already in because the videos are played within smart charts quite cleverly. That's why we call it a transformational trading platform. Shows you what to do in the platform, and then you literally do it in the platform. So that's quite a magical process that we had as the original design when we built this. So I'm now going to jump onto the screen. I'm going to show you the 180 phase change, just show you how it works, show you what we're trying to do, and then I'll go ahead and do it. So let's just jump into that right now. If you look at this video, I'm now going to play you. Smart Charts identifies the following conditions. For a long setup, the strategy requires the 8-period moving average to be above the 20-period moving average as further confirmation of a bullish trend. There should be a ring low bar pattern that is 2 consecutive bars with a lower low and a lower high on the second of the 2 bars. So just to be really clear, what I'm doing there, what the video says there is we're looking for an uptrend. We're looking where the price has pulled back. So that's 2 red bars consecutively. And then that sets up the entry price, the stop loss, and the profit target. You're now going to watch that on the video. Let's just jump back to that. The entry price would then be 1 pip above the high of the previous bar, with a stop loss 1 pip below the low of the previous bar, and with a target level of 1-to-1 reward to risk. These are the strategy defaults. Your order will be placed as a no expiry order. This means this will stay as a pending trade until you cancel it manually, or the trade is triggered by reaching your entry price. If a new seller's bar goes on to form without triggering the entry level, then we can simply cancel the order as the buying momentum we were forecasting hasn't presented itself. If the new seller bar goes on to form another ring low setup, it will generate another signal, and we can update our trade and buy at a better price. Now, what that video is really telling you is we're in an uptrend. Now, markets don't continue moving in one direction forever. That's ridiculous. Markets follow patterns of nature. Markets move in phases and markets move in cycles. So effectively, we have this phase 1, phase 2 arrangement where a market moves up with the trend, then pulls back to a median line, to a moving average, to an average center of price action, and then it should bounce back and then continue moving upwards. So if you think of it like in a kind of a biological sense, it's markets breathe in and markets breathe out. And what the 180 phase changer cleverly is trying to do is capture the market moving up, breathing back down, so 2 consecutive seller bars, meaning there's some selling, some profit taking happening in the market, and then for the resumption of the buyers coming back into the uptrend, you're then trying to buy that as it breaks the high of those previous selling bars to get you back into that new phase 1 movement. So it moves up, drops down, and then when it corrects itself again and comes back up, you're trying to capture that momentum. Benefit of that means that your stop loss puts you in a place where you're risking very little and you're capturing early momentum back into that end of that trough movement, that phase 2 movement, the resumption of the uptrend. So you're getting in early, and the key to buying anything, whether it be property stocks, bonds, futures, is to buy early at the right price. If you do that, you can then really sell at any price, as long as it's a bit above where you got in, and you can make a profit. If you buy late, if you're late into something because you're relying on emotions, you're onto a loser all the time. So this clever strategy keeps you safe, gets you in early, and then sets you up for a profit. So that's how, and I just wanted you to see that. I want you to see the video in Smart Charts, because what Smart Charts done, after it builds you all up and gets you clear on the technical environment of the trading system, it then shows you all of the trading strategies in a real step-by-step format. So this is obviously a long and a short strategy, meaning we can capture momentum moving up and we can capture momentum moving down. This obviously is for momentum moving up. This is a buying strategy. I placed a trade on this yesterday, which I'm in, triggered this morning. So I thought I'd now show you that trade so you can see exactly how it works. You've seen how the setup works. We're looking for those 2 pullbacks and then jumping back in. Let's jump now to the screen. So I'm now going to come out of the Learn area and I'm going to go to Charts. You can see that here. And you can see I'm in sterling CAD. So this is the British pound against the Canadian dollar. So let me just show you the entry of this trade. So I'm up 8,502 currently. The take profit is 172.99. The buy entry was 171.38 and the stop loss there is 169.98. So that position will run now for me automatically until it reaches completion at the green dot. Now, if I want to change that trade, if I'm not happy and I think it's probably going to top out before then, I can simply click on these, any of these orders, which is the take profit, the buy entry, or the stop loss, and now I can simply amend them. So you'll notice here that I am trading with 25 lots. I am looking to make a profit of 23,386. But I'll notice, if you notice on that green spot there, that is going to be there for an all-time high recently, certainly a recent all-time high. And I might decide actually I want to be a little bit more aggressive and take my profit off the table rather than leaving it to get to a place it may never get to. So if I wished to if I wished to adjust my take profit, I can now simply drag this. You'll see the numbers change on the screen as I am dragging that. And I can be a little bit keener and bring it down and say, well, I'm happy with a profit of 15,000 here. And if I then hit the tick box, which is now bottom right, I've adjusted my take profit. That order is now updated. If you look, I've added the ATR 10. That's the average true range indicator. What does that tell me? Well, it tells me the average range of that currency price range movement over a period of 10 periods. In this case, a period is a day, is a daily chart. So over the last 10 days, it is telling me that this indicator has moved around. If I now change my, my grab tool to a crosshair, and I put my crosshair over here, we can see that way back here in October, this currency was moving something like 208 points. Okay, now over the last month or so, it's now moving around 108. So it's half its volatility in the last month. That means sterling, you can see that back here, it was moving around very volatile. Down here, it's still quite volatile. But as things have moved along, price ranges have started to reduce, and that means there is less confidence in that direction. But let me just show you that. Let me just draw a trend line of that. You'll see, look, if I take it from that high point there down to here, you can see we've gone from average volatility of around 208 pips a day. That's 208 pips that currency pair has moved around on a daily basis back in October a month ago, to where we are today in November, where volatility is down to 100 pips. So volatility across November right now is half of what it was in October. What does that mean? Well, that might now be indicating that this currency has or is starting to top out. We're not getting the big pushes that we got back in October, and it could now be starting to fade. So to protect myself from potentially losing out on this trade, my stop loss is in a sensible place. I've moved my take profit closer to where I got in. So I aren't going for the 26,000, but I am going for 15,000. All I've had to do is move the flags to adjust it based on that trend of volatility sort of easing up. And that makes my trade safer, and it gives me a greater probability of banking a profit, and I've still got a very acceptable reward to risk for this type of position. So that is a 180 phase changer. I've shown you the video of how to get into it. I've shown you me placing the trade, or actually I placed the trade already. I'll place another one now so you can see it. And now I've showed you some trade management based on intel that Smart Charts is informing me about what is happening to this trade as it's in play. I think what you're going to love about Smart Charts is it doesn't just show you the whole environment you're trading in the platform, but it shows you the strategy step by step, how the strategy works. And then it's got some amazing reference tools which give you a really strong indication as to how well the trade is going to play out. So your trade risk management and your trade playout management is managed to perfection. So that trade is now running. I can now leave that trade. If I go to trades, I'll show you where it sits. It's obviously open. If I click on that trade here, Smart Charts is bright enough to then show you exactly where you got in the trade, which of course was here, how much profit you're in, and the trade is running. I can close that trade, and if I hit take profit, it would take the trade off the table. Not going to do that. I'm going to let this position run, but that is where the trade management is. Any pending trades are in here. There's another one from yesterday. That's another Aussie yen trade that I placed on the daily chart. If I click on that, it will also show you that trade. So I've got my stop loss, my sell entry here. Hasn't quite hit that sell entry. It's not far from it. That trade could trigger at any time. Do like the look of that trade, and that should run well. So again, that stop loss is up there at 74.12. So of course that is a short trade, meaning when the position falls, I look to make a profit for it falling until I take the profit there at 73.27. Let me now walk you through exactly how I go about placing a 180 phase changer trade. I just want you to understand also, even though I'm trading on a laptop, I know many of you love to trade using multiple screens. You can see behind me my other trading terminal back there. My screens are reversed, so I can, whilst I'm doing this instruction, if I want to look at any positions I'm in at any time, I only need to turn around and I can see them. Other than that, when I'm sat back there, I can see all my screens. Now, some of you may wish to use Smart Charts and have it sprayed across many screens. Dead easy to do. In fact, Smart Charts can run up to about 100 screens simultaneously. I think you'd be a bit of a madman if you did run 100 screens simultaneously. People do that, though, I'm told. But it's quite common for people to run anywhere in the neighborhood of 12 to 18 screens. So if you wanted to do that, it's really, really simple. This screen, for example, this Sterling CAD screen, all I hit is this icon here, which is this icon with a square box with an arrow to the right-hand corner. That will then pop that screen out, and I can now push that screen anywhere I want it to go. So I could then drop that onto another screen I may have attached to this laptop. In fact, some of you who are intrepid traders on the move will be using some new technology we are going to be releasing shortly, which is a cover for your laptop where you can pull out 2 extra screens. So you have 3 screens simultaneously on the move. Very cool piece of software. If you're interested in that, leave me a comment in the comments field. Leave me a note in the comments and I'll tell you how you can get hold of one of those screens. They're really cheap. You can slide it onto a Mac or a PC and you can then pull out extra screens and you've got 3 screens on the move. Anyway, so that's how you would do that. So I'm going to close that screen now. And I'm going to go back now. So now I'm going to use this middle icon, which then shrinks the screen down and lets me see all of my positions that I'm looking at simultaneously. But I'm actually going to now go to another 180 phase changer so you can see how this works. And I'm going to show you exactly how I get into this position, how I scan, and how I place the trade. So we know 180 phase changes. I'm going to change my arrow tool to a grab tool. That means I can move my chart around however I like. This is one of the beauties of Smart Chart that really allows you full flexibility. Some people like their data displayed exactly how they like it. I am that kind of cat. So having a grab tool allows me to move my data around and have it just how I want to see it. So how do I get into a 180 phase change? Well, I go top right of the screen, which pulls out the strategy scanner, allows me to see all of the strategies I'm looking at simultaneously. I'm not going to confuse you today with looking at all sorts of different strategies. I really just want to focus on the 180 phase changer, which you can see here. And there is the list of currencies. Now, on that list of currencies, bubble sorted, that's a mathematical term. Bubble sorted means that the currency pair which closely matches that strategy is bubbled to the top of the list. The one that's weaker than that slightly is lower. And of course, right at the bottom of the list is the currency pair which really doesn't match the strategy right now whatsoever. So the best example, your best bet, if you will, or your currency pair most closely matching this strategy in today's example on a 4-hour chart here is the euro against the Canadian dollar. So let's click on that and it'll bring up the chart of the euro against the Canadian dollar. Now you might, if you're a beginner, you might be wondering, what do I do here? Do I buy? Do I sell? What's the story? And this is a classic example. If you're not sure and you've never used smart charts for the first time, the trick always is to look at the red and the green button and which one is glowing. So you can see the red button that is glowing here. If I just leave my mouse off it, you can see that pulsing movement of red tells you this is a short strategy. If you aren't clear about that, just looking at the screen, you'll see the red fading background is indicating you should be going short on this position. Now, this is a nice looking trade. I looked at this earlier this morning. Why is this so good? Here's why. You've got amazing time frame correlation. You've got moving averages moving down. You'll notice, watch as I now move my mouse across the screen. So you'll see the market falls and then it resumes back to the moving average. Then it falls and then it moves back to resumes back to the moving average. And then you can hear the pattern. It should now be looking to fall. And if you look closely here, and I'm going to kind of enlarge this so you get a real good view on this. There we go, like that. There we are, perfect. So if you'll look here, there's 3 dots, the red, the blue, and of course the green. Again, we're just nipping in, grabbing a sexy little profit that is really lined up for us. We've got a nice overextension bar here, which means that the buying pressure back to the mean is drying up. Again, volatility is reduced, no problem whatsoever. So all I'm going to hit now is the red glowing button, which will bring up that 180 phase change. It'll give me those 3 orders again, the entry, the stop, and the take profit. So I'll hit that. And you can see, look, it's saying sell entry at 146.17. Again, 25 lots. I've got a stop loss at 146.32, which is here. And my take profit is literally 15 pips below at 146.01. Really like the look of that trade. If I'm a betting man, which of course I am, probability of that being successful is very high. This is a very successful strategy. You can see the one previous was successful. Wouldn't have taken these ones because they weren't at the right stage of the cycle. I want it coming back to the moving average as it does here. This will very likely be repeated. So I'm going to OK that and I'll just hit the green button here. If I want to adjust this at all, I can. If I wanted to take a little more profit, I can just click on that and drag that down and get myself to about 2,800. I think that's safe. My stop loss, if I wish to amend that, I can move that just ahead of those moving averages. That can give me a little more protection. And then if I hit the green button, those numbers have now all been changed in the order ticket for me. I'm now using reduced risk and I hit confirm and that trade is now placed. It hasn't activated in the market yet, of course. It won't do that until the price breaks through this level of 146.17. You can certainly see the price right now is 146.41. So it's got about 25 pips to run until it enters into that position. If it does, then we will be short and we will look to collect profit when we get just south of the green dot. So that Euro CAD is now placed. So today we've looked at the 180 phase changer. I hope that's been really helpful. You've seen how I select a trade. I've showed you, I started off by showing the video so you can see the training on it for both a long and a short trade. I showed you the 180 phase changer that triggered yesterday that's currently in play. That's happily moving along into about 7,000 to 8,000 pounds of profit. We'll take that off the table when it hits 15,000. We also looked at the change of the average true range and how that can indicate that maybe some of that price range movement is shortening down. So get a little bit more aggressive, take that trade off the table when you're ready. We also looked at placing another trade, which was a Euro CAD on the 180 phase changer. I hope you found this really useful. I'm going to be doing a number of these from the live trading sessions with Greg from my trading den here at my home in the UK. If you have any questions, any feedback, any comments, please do leave them below the video and I look forward to seeing you on another one of the live trading sessions with Greg. Hi guys, welcome back to the Trading Den. My name is Greg Secker, your host here, and today we're launching a brand new initiative. We are starting to do weekly market forecasts and market context positioning. What is that all about? Well, it's a new concept that we're bringing here to the Trading Den, where I give you a market forecast every week, show you really what's happening, what to focus your energy, your attention, and most importantly, your trading strategy and focus upon. And that is something we're going to continue doing alongside the quests and alongside the educational pieces that we do on a weekly basis. So we're going to start that right here, right now. What we're going to do right now is get right into how the market is set up right now. I'm going to show you how I set my day up. It's kind of important that you have the opportunity to see how I set the game up each week. Now, of course, market conditions change every week, and for that very reason, I want to spend my time now on a weekly basis setting you up on a Monday or a Tuesday, depending on which day I get on, but hopefully the earliest part of the week, to really show you how the week's going to play out, show you how my mind is thinking, and show you where I'm finding opportunities and how I'm setting myself up for the game. So we're going to jump straight into Smart Charts, our favorite tool of choice, of course, and show you how I'm setting the game up. Now, I want you to know off the bat, my favorite currency pairs are the euro dollar, our sterling, and dollar yen. I also love the Aussie dollar and I love the Kiwi dollar. You're going to see why I love the Aussie dollar and the Kiwi dollar, because I've already got trades on those this morning. In fact, some of those trades have already completed and hit me a profit. So I'm going to show you what I'm looking at, why I'm looking at it. Let's dive straight in. And I've set my screen up slightly differently today, and that's for a very good reason. Today we are the 9th of June, and that means that markets have changed somewhat. We've seen big swings in the markets. I'm going to start with the euro. I'm going to move through sterling. I'm going to look at the dollar yen, and then I'm going to look at my favorites, the Aussie dollar and the Kiwi dollar, and then I'm going to wrap the session up here today by looking at the indices and that early morning market breakout. Now, for those of you that have seen previous videos I've done, I have shown you the breakfast breakout. Time is right now 8:45 in the morning. So that hour period from 8 in the morning when the UK stock market opens to 9, that hour range creates us what we call a breakfast breakout range. You're going to see if that range is created this morning and gives us the opportunity to place a breakfast breakout trade, because market conditions right now are between trending, highly volatile, and breakout. Let me show you what I mean. Let's start right now with the euro. And I want to look at how I've set my screen up in Smart Charts. You'll notice on the left-hand side, top left-hand panel, I've got a fib screen on the daily. And the reason I'm doing that is I want to draw your attention to the levels. Then I'm looking at a strategy screen, which of course is the 180 phase changer. Then I'm looking at an alligator, which is telling me if it's trending or if it's ranging market conditions. And then of course, lastly on the bottom left is my pivot screen. Now, why have I got my screen set up like that? Well, let's go through it and show you exactly how I set the game up in the current market condition we're in. The current market condition we're in, just to be really clear, is we've had a great trending run, but things are starting to change right now. Markets are topping out. We're having some retracements coming in, and we're seeing some ranging period. You only have to look at the euro dollar on this 4-hour chart to see, whilst we've had these nice ranges up here on the daily, we can see now, of course, if you look at the bottom right-hand screen here, that alligator, if you haven't seen that alligator indicator strategy I released last week, please go and have a look at that. In fact, if you click on this icon here, you'll get straight into that video. The alligator strategy really tells you if markets are ranging or if markets are trending. We know that it's easier to make money in trending markets than it is ranging markets. So what do we do? What do we do when markets are ranging? We've bet our buck on trading the markets. We don't have a day job. We want to make money in the markets without putting ourselves in a position where we're taking on too much risk. But how do we set ourselves up so we can take advantage of trending market conditions, but being aware that markets may well have topped out, such as the euro dollar? There may be further upside. We know we've broken those big fib levels, but what happens if that market starts to range? How do we set ourselves up so there is opportunity for us without taking on extra risk to kind of falsely create an opportunity that doesn't really exist? How do we set ourselves up when we're in this difference between a nice trend and then a flattening and a ranging market? 2 weeks ago, very easy to trade. We had markets breaking out, alligator opening up, trends starting, very easy to pick longs, picking the bottom, buying those dips, simple stop, grabbing profits. You can do that all the way along for the last 2 weeks. Now, markets are starting to get into that phase 2 mode where they're starting to retrace and pull back, and flatten out? How do we set ourselves up? So let's take a look first of all at the euro dollar. I want to draw your attention to the fact, in fact, if I just move if I look at this major swing that we had up and down, by the way, if you're not aware, this is the daily chart. This is the fib level, and you'll notice there seems to be an interaction around the 71% level, the 78% level on the Fibonacci, which means it's broken through the 61% level when the euro dollar bounced and then started moving back up. So this was that big retracement, and then we're trying to get back to that 100% retracement. We did break through the 60%, but you can see if the daily is looking like it's flat, you can certainly see on the 1 hour and the 4 hour, you're talking about a real ranging market. So what does that mean? Well, it means that in this current market condition, we must be aware, first of all, what is the upside, what is the downside potential? Breaking the 61%, we would expect that market eventually to get back to that 100% retracement level. So effectively, we are expecting further upside. But if we are day trading this market, we've got to take much more of a session-based view. So our view really is that we expect the market to continue up and to continue further, hitting that 100% level. As we've learned in previous sessions, if the markets break that 61% level, we'd expect it over time on the daily to get back to that 100% level. But really, what is happening? Well, if we now look from a session-based perspective on the euro dollar, we can see it hit that pivot line. For those of you that don't know much about pivots, if you click here, you'll see the pivot kind of strategy training session I did previously. But effectively, if the markets break through that pivot, we're looking to take short positions from a session basis. Now, if we jump back to this 180 phase changer, we can see lots of longs being called, but you'll see there's a real disparity between the longs being called on the euro dollar and what's happening from a pivot type picture. Then, of course, we look at the alligator, jaws are closed. What do? Answer, euro dollar, absolutely nothing is the actual answer, what we want to be looking at here. We know the market's flat here. There isn't strong trading opportunity. We'd expect to see similar things across cable. So we're going to have a look at cable. But where we sit right now is you've got conflicting signals really between euro dollar on the daily, on the 4 hour, and then of course what we're seeing on that 5 minute picture on the pivot line, which basically means that market is going like this, tick tock, tick tock. If you go in there and try and play the tick-tock game, play the ranging game, you're going to get burned. So don't do that. That's my first analysis. Always start with euro dollar first. Why? It is the most traded currency pair of all time. The euro dollar has the most volume. It's the European community against the US markets. Of course, it's the most voluminous traded game in the world. So very important to notice that we are in a flat market on the euro. I'm going to switch now to sterling so you can see what we're seeing here on the sterling analysis. You should see a relatively similar picture. Again, if I bring up the fib chart on the daily, and it's a great way to start, guys. We start looking just what is the swings? How is the game setting itself up? And what you should really notice here is that as we had the high here and then we had the low, in fact, if I bring these numbers across, you can see that the high here was, of course, that 132 level. The low here was that 114 level. Serious swings in currency movement there. You'll notice that as that technical picture has broken through the 61% level, we would expect this now to go all the way up to that 100% level. We'd expect that to happen. We are seeing a flattening or a beginning of a flattening of the picture as we saw on the euro dollar. Again, what does that mean? It means you're going to see mixed signals. So you're going to see some longs being called, say, on your 180 phase changer, tempting you into the market to try and get you to place a trade long, or certainly that strategy, if it was campaigning to be used, it would be saying, come on, place a long. But you've then got to look at the bottom left-hand picture. Pivots broken down. This is on the 5 minute chart. And we're seeing a short picture as well here on the hourly chart. You can see that big drop just happened. We're starting to see the alligator now turn. So whilst it's been not very much movement here, in other words, the lines are quite close together, now they're starting to turn down, and we could expect, and we could see, in fact, a reaction just before that 78% fib level, and now starting to pull to the downside. So again, you've got mixed signals on the euro, got mixed signals on sterling. Let's have a look at the dollar yen. This is our next currency pair. So this is how I set my day up. We go euro, we go sterling, and then we go dollar yen. They're the three majors that I want to take a look at. Remember, make the most important thing the most important thing. And the most important thing in currency trading is understanding where those major markets are going. Now let's look at the dollar yen. So we're going to move along now to dollar yen. And this is the picture you should see on the dollar yen. Now we have got a small trade on the dollar yen. It's a little pip runner. I'll show you why we're doing that. First of all, let's have a look again at that fib picture. Remember, we start here with the daily. We start to see if there's any major market trends we should be aware of. This is what I really want to draw your attention to on the dollar yen. Again, we've got that big swing in movement that we've had over the last few months. Of course, we know what's been happening with all the craziness in the markets that we've had since the beginning of the year, of the world being on fire, to the coronavirus and everything else in between. We're seeing a big rejection on that 78% fib level on the dollar yen. So as that's happening, you're seeing this green line, which is the 200 period moving average. Folks, always put a 200 green line exponential moving average on your charts, critically important. The red line is the 50 period moving average. That's kind of your quarter against your year in terms of trading days. So 200 trading days against 50 is what a lot of prop traders are putting their energy, attention and focus on. I want you to notice that. Now look, you'll see my P&L is swinging around here. It should do for an account this size. Don't let that concern you. What's important and want you to focus your energy on is that we've broken through the 200 here. We've had a big rejection off the 78% level. I expect this to pull back at least to the 61, which it has, could go further to the 50% level. How does that tie up with the rest of the picture? Well, interestingly enough, if I drop down here to my bottom left screen, which of course is my pivot screen, you'll see that we're already well underneath our pivot point line. If you look here, look, the pivot point line's above. So we're kind of snaking along here. Again, it's more of a ranging position. So how do I capture some profit in this period of time? Well, I've placed here a pip runner, which was called early this morning. Now, the pip runner here was this one here. Now you'll notice with this market condition, you'll notice that you'll get longs and shorts called. That's completely acceptable. But I know I've got a good, strong rejection off that fib level. I know I've just broken through the 200. This will bobble around and it will move around. I'm completely comfortable with that. I want you to be comfortable with that as well. Obviously, you're going to be using different size trading accounts than the one I'm using here, but there is a good opportunity here to grab a profit at 107.62 on the dollar yen. There's good downside pressure here. I'm expecting this to continue. If I then look bottom right, which of course is my alligator, you can see it has flipped over and those jaws are nicely open. So I expect that trending movement, that grab, that pip runner and take a profit at 107.62 is where I am banking. Now you'll see this swing around in this trading session. Very common, very normal. Don't ever play the game where you look at the P&L and watch it move up and down. So they're my three majors. Now, what else do I add to the mix? Well, you might be surprised to know that actually in terms of volume this year, one of the most traded currency pairs is the Australian dollar and the New Zealand dollar, but most importantly, the Aussie. So I want to jump into the Aussie right now because that's something that I think you really should be aware of. It's something I placed this morning. So this is my Aussie analysis. Now, here's an interesting thing to be aware of. First and foremost, okay, let's look at the Aussie. You'll see that the Aussie on the main picture, now let's bring that up in terms of fibs and bring that market along. Hold on. Here we go. Now, you might think, well, hold on a sec, Greg. This looks like it's in a major uptrend, right? Since it's retraced from around the end of March into early April. Hold on a second. Let's just auto scale that back and move that across. There we go, nice and clear. You can see, look, we've got this lovely rejection off the 100% level. Now, for those of you that trade only above the 250, great beginner strategy, but I've got a nice rejection off that 100% retracement level. I did place a trade this morning. I want you to be aware of that. It was a pivot trade. So let me show you where that happened this morning. This was my pivot trade this morning. If I turn my flag on, you'll see here this morning, I nipped in and I grabbed, if I click on this, you'll see, let's have a look at the trade. I took $5,000 this morning, a little bit earlier than I would have got on camera with you. There are other opportunities in this market. I'm going to show you how to identify them. But, you know, this is a game of early bird catches the worm. And this morning, we're recording now. It's just about 9 o'clock, which is perfect timing because it's going to allow me to show you what's happening in the breakfast breakout arena. And that's something I'm going to be excited to do. But I just want to show you and review these two trades I've done today So I'm looking at pivot trades. I've looked at the pivot because it's 100% fib level, rejection, moving down quite strongly. I jumped in, I grabbed a sell just as it broke through. I had to be quick. It was a very manual trade, but I had to be quick and grab what I could. The trade took half an hour, $5,000. I opened here at 69.70, had a stop loss at 69.90, I had a take profit at 69.50. So nice little 20 pipper, off I went. And a great simple trade. Did the same thing on the Kiwi as well. You should see those two things closely correlated. They are commodity-based currencies. They do react to commodity prices, and they have had nice rejections, which means there's a good shift to the downside. So that was my Aussie this morning. Notice what that looks like on the rest of the world. You could say, if you were a beginner, you're like, well, on the daily, the price is above the 50 and the 200. But wait, it's rejecting off that fib level. Now move over to any of the other screens, and you should see confirmation of that big drop as, look, the alligator is turning over and opening its jaws. You can see the big drops down that we've had this morning. It's on the 1 hour chart. You can see the break through the fib levels, the fib level here, the test on the fib level, but the breakthrough on the pivot levels. It means that we managed to get in, grab a quick and dirty profit, and then come out again. Same thing I'm now going to show you on the Kiwi. So let's move into the Kiwi, and you'll see how what I've done with smart charts here, and I want you guys to be aware of this. And these are just two quick dirty strategies that I've got on. When we do more of these market forecasts, I'm going to try and record these earlier on a Monday so I can actually do them live with you so you can actually see these. But please put comments in on this video if you like this style. We sit and we strategize what we want to talk about, what things are important. From a lot of the comments we've had, they're like, Greg, just trade live with us. Show us how you do it. Well, you got to get up early if you want to trade live with me, because this is a 5:30 to 6 o'clock a.m. Greenwich Mean Time. We're actually in British summertime right now. So that's 7:30 in the morning if you're on the GMT time, but it's an early session, so I have to get in early, and if you want to come join me on any of those live trading sessions, please put that in the comments and I'll guide you step by step with what I'm doing. I want you to know though that these are, I'm not giving you trading advice here. These are just what I'm looking at in the market. So anything I'm telling you here, you guys have got to figure out what you want to do, okay? This is certainly not any kind of trading advice or any financial advice. This is how Greg Secker sets up his day and what he's looking for. And in current market conditions where you've got some trending markets changing, you're getting rejections off fib levels, I think learning in context for you is going to be the next level of what we're going to deliver to you on this channel. And I think it's going to make a real big impact, because the quickest way to learn something and understand something is to do it. I'm a big believer in apprenticeships beat university degrees, and I really mean that. I'd rather you learn in context, like you're sat next to me doing this with me, and I think by doing that you'll get a lot more experience and you'll be able to apply it to the market. Let's just take a look at this Kiwi again. Left hand side here, we have got same thing. Okay, so watch this. We have kind of a weird spiking line here, which is a weird spiking line. And what we're going to do is I've moved my fib level to the bottom here. However, this kind of spike does confuse the fib level a little bit. And if I just adjust this a little bit and say, well, actually, if we ignore this red spike line down here and it's more here, you'll see, interestingly enough, it's more of the same sort of rejection that we've been getting on the Aussie dollar, and which of course has allowed us to place the same type of trade that we did this morning. The pip run, of course, is showing a short here. This is not really, we're not really looking at pip runners here to get into this. We're looking more importantly, again, at the breach, the break here of the pivot point line, which is really important. And you can see again how that alligator, that trending alligator, is opening its jaws to the downside. So this, again, a beautiful pivot break. Now, when you are struggling for finding a trend, you're really then looking for breakouts. That's why I'm now going to jump to the UK 100, the FTSE 100 breakfast breakout strategy, because in this world where markets trend up and trend down, there are, of course, in between that, big chunks of time when markets go sideways, and that's really what you're looking at right now. So these breaks where clearly you've got nice rejections on big daily charts on Fibonacci levels, which you're seeing on the Kiwi and on the Aussie. You saw what we did on the Euro, we saw what we did on Sterling. That is not to be ignored, because that's where you can pull great pip movements by clearly seeing nice fib rejection level and then a nice break in pivots. You add those two things together, you can really add some punch to what you're doing in the mornings, and that is really critical. Otherwise, you're going to sit there waiting for the markets to turn around again and retrend, and of course, by the time it's retrended, you're going to be too late into the game. So let's just look at this trade we placed a little while ago this morning. If I click on these flags here, hold on, let's see if I can, one sec, there we go. So this one we had a sell at 62.26. Stop loss was at 65.46 and take profit at 65.16. We just grabbed quick in and out, 10 pips. Market was moving quickly. I did actually adjust this slightly wrong. Have to be hands up and a bit honest here. I meant to go for but between 18 and 22 pips. I kind of finger fudged it this morning because I was doing 10 other things preparing for this session. Only managed to grab 2,650. But again, it's half an hour type stuff. So in, out, big rejection off the fib level, trading those pivot point lines. If you enjoy looking at me doing this in context, please put comments in there or any questions you may have around this, because it's a perfect market condition right now to see that difference of trending to then breakout market. I'm now going to jump I'm now going to leave my major currency pairs. So remember, Euro, Sterling, Dollar Yen, Aussie, Kiwi. They're your five that I like looking at in the mornings. There's always play there somewhere. And I will say this, don't try and get into the market and do something when nothing really exists. And I want you to understand my rationale for doing all of those trades. My next move now is to look at the breakfast breakout. There we are. Okay, so last but certainly not least, we've just crossed 9 o'clock. And as we've done that on the breakfast breakout strategy here, we can certainly see, look, it's that zone, which is that hour, that trading range between 8 o'clock in the morning and 9 o'clock in the morning. Now, look, markets are softer this morning. We know that. You can see that Smart Charts is calling a short here when we break through this bottom of this blue line. The stop, of course, is this red dot above that zone. So if we hit short here, you can see it says, right, Greg, you're targeting $17,000. That's 36 pips. Your stop loss is just above the channel. Perfect trade setup. I love it. In fact, it's very much consistent with anything and everything I'd ever want to do. So this is something I'm absolutely going to jump into in front of you right now. Why? Look at the 50 and the 200. Clearly obvious, isn't it? The 50 is just crossed through the 200. Price is underneath. Can't wait to get this trade on. It is on. I'm very confident with this. We'll see how this pans out. But this is the kind of trade setups that I want you to be aware of. So whilst we haven't got easy trends to pull right now because markets are changing and moving around, we've got to set ourselves up. The window of choice I like to start with those fib levels in the top left-hand corner with a strategy in the top right. I want pivots in bottom left, showing me if there's a break of pivots and a bounce off of Fibonacci. I've got some strength there. I then move over, of course, to my major markets, which of course is UK. And in a few hours' time, I can look at the US markets. I won't be doing that. I'm a Euro session trader. And so I'm very comfortable, as you can now see, that market is pushing down further. There is softness. If you look, by the way, you go back in time, you can see the success of these breakfast breakouts. Here's a profit. I think the one before would not have made it. And you can see how well it does just by scrolling back. So that's something I want you to be aware of. It's something I want you to add to your arsenal. You can see if you just go back in time, you can see all of these. And you should be able to make an analysis real quick just by looking at the last 10 as to how many were successful. Those using Smart Charts can do that in a split. I'm going to delete this fib level off here because that is going to be a distraction for you. Let's take that off. And here we are this morning. 1 second. So just going back in time, you can see exactly what this market has. Now, hold on. Let's just hit auto scale. If you ever get lost, hit auto scale and it'll just put you straight back to where you were. Let me just jump there. And this is the market we are looking at right now. And you can see literally in front of us. Let's just check this out. You couldn't probably ask for a stronger signal. And these are trades I think you guys are going to want to enjoy doing with me. Market's pushing close to that level. That entry level is 64.12. Going to look to take a run to 63.56. So there's a nice little movement there. Maybe $17,000 worth of profit. We'll check in with that in the next few videos to see how well that one did. If you enjoy this new style, which we're looking at launching this on a Monday, Tuesday, most of the time it'll be on a Monday. We just had some configurational issues in the studio yesterday, hence why we didn't do this yesterday. But if you're interested in doing that, we'll then look to maybe push that into a live format or just record it and then drop it straight out to you. I think it's going to be something I think you guys could benefit from immensely. Now listen, guys, if you like this video, Okay guys, I just thought I would take the opportunity to show you the trade working out. We have actually just finished recording, but I just wanted to show you the breakfast breakout. Lovely little morning. As anticipated, this beautiful little trade is working out lovely. I'm on my way, I'm up 12,388 right now, on the way to 17,000, so it was worked out very well. Look, you've got your cross on your 50, over your 200. This is exactly the type of trading you should be doing in this kind of market where, you know, you haven't maybe got big trending opportunities, but you've got markets pulling back. Bloody lovely breakfast breakout, happy with that. It's going to be a 20 grand morning, which, you know, by all intents and purposes, no one can be disappointed with. Yeah, we're going to let this trade run. When it finally hits the profit target, I'll have made 17,000 alone on the UK 100, which is a great trade. I hope you guys are enjoying this format. And again, if you like this video, don't forget to hit like, and if you haven't subscribed already, get yourself on there, because this is going to be a new format for the show where we're going to show you not just how to trade, but we're also going to show you doing it in context to the current market conditions. So we're just going to let this one run. I now have a tennis lesson that I'm going to go to, so hopefully by the time I get back, I've now locked in a nice 17,000 on that. The other trades that I had on this morning have all hit their profit target. My little dollar yen is sitting there just waiting to get going. If you see the sell entry there, loving the high tests you'll notice on there. That's probably now going to pull into a decent profit. I'm very comfortable with that trade. Either way, so market's looking good. Happy with how the day has worked out. We pulled a nice 5 grand on the Aussie, pulled a nice 2 grand on the Kiwi. That's 7. We're pulling another 17 potentially on the UK, falling nicely. That takes us to about 24,000 for the day. And if the dollar yen comes in, who knows, we may hit a 30 grand morning, which by all intents and purposes is not a bad way to start this day. Hope you're having fun out there, everybody. I look forward to catching up with you on future sessions. Thanks very much. Is there money to be made in sideways markets? No, not really. I can tell you for sure that if you've been unknowingly trading trend-based strategies in sideways markets, you're leaving your success much more susceptible to chance. What can we do to help identify what type of market condition we are actually in? And how can this little fella right here help us figure it out? That's coming up right here, right now. You know, markets range for about 70% of the time. That is to say that for 70% of the time, there is no definitive overall market direction. Ranging market conditions are typically caused by indecision from those major market participants, where no one is quite sure what to do next. No one quite knows what the play is. And they may be waiting for certainty from announcements from governments or from real world events. And so typically we see markets bounce between really a couple of levels, with buying or selling pressure building up behind. Whilst the market is ranging, you really don't have the volatility to get in, take a profit and get out. You're really just going to be paying brokerage costs, and in most cases it's going to be hard for you just to cover the spread cost of the trade. And this is when you're typically going to be sitting in front of the screen with your arms folded, waiting for the bloody thing to move. It's also important for you to note that institutional brokers make their money in strong trending markets, not in ranging markets. You should also know that most new traders that lose money are losing that money in ranging markets. For these reasons alone, learning to recognize the difference between market conditions should be high on your list of priorities. It's not impossible to make money in ranging markets, but if you're just starting out, why not go for the lower hanging fruit? Trading markets, after all, afford us an abundance of buying and selling opportunities. Like I've said in previous videos, in an uptrending market, we're looking to buy at the point which the major market changes direction or phase back to the major price direction on the time frame we are trending. And a lot of the trading strategies bundled inside smart charts are trend-based strategies. That's to say they are specifically designed to be used in trending market conditions only. In smart charts, when you use any strategy, you can examine previously triggered signals.
So here's a 180 phase change of strategy chart. These dots right here are showing you the entry, stop loss, and take profit levels of previously triggered trade based on the strategy rules. Now the blue arrow is showing you the direction of the suggested trade. When it's pointing up, it means the strategy suggested a long trade in this instance. The blue dot is the suggested entry level. The red dot is the suggested stop loss level, and the green dot is the suggested take profit level. You can therefore use this tool to figure out for yourself when a strategy has been successful in the past. However, if you do decide to do this, there are a few things you should take into consideration. The first is that these strategies throw up signals regardless of the overall market condition. The 180 phase changer is a trend-based strategy, but a lot of these signals were thrown up whilst the market was in an obvious sideways condition, like here or here. The strategy isn't doing the overall market analysis for you. It's up to you, the trader, to determine the market condition and to verify that the signal is therefore valid in each case. So when you look back over a strategy's previous signals, be sure to factor in the overall market condition the signal was thrown up in. Most of the time you can see this visually. Here is a signal quite clearly thrown up in exactly the conditions we want to see them in. We have two clear previous cycles of higher highs and higher lows, and the signal was thrown up at exactly the right point, where phase 2 moves back into phase 1, just as it's shown in the training module for the strategy. In this instance, we can see that these signals were thrown up when the market is ranging between these 2 points. Would have you have taken these trades? No. When you factor this in, you will note that a strategy's success is dependent on the market condition the signals are thrown up in. For the 180 phase changer, trending markets will yield results. Ranging markets, not so much. You may see streaks of winning trades when the market is trending, and streaks of losing trades when the market is ranging. And that is why step 1 of our 6-step trader cycle, trends, is about recognizing your market condition first and foremost. It really is mission critical. If you're planning to go sailing one afternoon, your first critical step would be to check the weather forecast. The market condition to a trading strategy is exactly like the weather condition is to an afternoon sailing. If all of this so far is going over your head, then I highly suggest you click the link in the description below and get yourself a free 7-day trial of Smart Charts. Included with the trial is several hours worth of the highest quality trader education material on the planet. It's clear, it's structured, and most importantly, it's completely free of charge for my YouTube subscribers, meaning you can watch it all, get yourself up to speed, and can therefore get the most out of the information on this channel. Now, for those of you already up to speed, I want to introduce you to an indicator that can help us identify market conditions, and it is called the alligator. In fact, of all the Smart Charts indicators, the alligator indicator is one of the first on the list, so it's pretty hard to miss. Apply it to a clean chart and the 3 lines will appear over the price action. Let's talk a little about what these lines mean. In principle, the alligator indicator is a combination of balanced lines or moving averages. The 3 lines are known as the jaw, the teeth, and the lips. Now, when the jaw, teeth, and lips are closed or intertwined, the alligator is going to sleep or is asleep already. The market is therefore ranging. Remember, ranging markets are what we are trying to avoid here. So this is a signal for us to stay away. The first thing the alligator does as he wakes up is to open his mouth and yawn. As the jaw, teeth, and lips move into their proper position, the alligator is said to be hunting. It hunts bulls and it hunts bears. In this configuration, with the lip above the teeth and the teeth above the jaw, it is hunting bulls. That's to say, it is signaling a bullish market. In this orientation, with the jaw above the teeth and the teeth above the lips, it is hunting bears. That is to say, it is signaling a bearish market. The alligator is said to be eating when a candle closes above or below all 3 lines. Get that? When the alligator wakes up, that's when it's time to go and make some money. So let's have a look on Smart Charts. So for this demonstration on smart charts, you'll notice that I've set up a new pane of windows called the alligator windows, and that's purely just for this demonstration. You'll notice the two screens I'm focusing on. The top screen is the higher time frame window, which is the daily chart, and that's the one that I'm going to place the alligator onto, because the alligator then is my higher time frame, and it's going to tell me if I'm in a ranging or if I'm in a trending market condition. Now remember, we want to keep away from ranging market conditions because they won't have the movement to allow us to get in and out of our positions successfully whilst covering costs. And we therefore want to focus when the jaws of the alligator are opening. So that higher time frame window, which is the daily, is the time frame of reference, is the window I will be applying the alligator to. So let me just do that now in Smart Charts to show you how I do that. You'll notice as I look at my list of indicators, it's literally the second one down. If you want to type it in, you can, and it will find it simply by typing in the word. I hit alligator, I place that on my chart, and there it is. So we can see with these lines that are intertwined on the daily, not much is happening. But over the last few weeks, we can certainly, also over the last week or so, we can see that the jaws are now opening. The green line is above the red line, which is above the blue line. So remembering that green line is the lip, the red line is the teeth, and of course the blue line is the jaw underneath. Now, if you notice, these are daily charts, right? So these are daily bars, this is a daily chart. Below that same currency pair, notice how Smart Charts, we've got them series linked, red to red. So whenever I click on here, it will paint the window in both windows the same currency pair. So it basically series links those currencies. But of course, in the window below, I'm not looking at the daily chart. I'm looking at, of course, placing a trade and applying a trading strategy. As I told you, I'm looking for trend-based trading strategies. The market we're in right now is very much a trending market with great volatility. So if you look at the chart below this alligator chart, of course, the alligator, if you can imagine now, its mouth is opened. That therefore means we have the ability and should be looking for bullish movement. So the first rule of thumb I want you to remember is that if price is above the alligator, that in itself is a bullish move or is a bullish signal. Don't forget, each bar on here are not daily bars. So this whole section here accounts only for a few days. You've got to understand that each bar here is 4 hours. Above each bar is, of course, a day. So there's much more time horizon, of course, at the top. In fact, just this little area here, if I was to stretch this out, this area here where you can see, if I make it bigger to make it more obvious, probably accounts for the 4-hour window below. So you'll notice as the alligator on the daily chart is opening its jaws, it's opening its lips and it's opening its teeth, we'll notice therefore that the signals start appearing on the 4-hour chart. Notice this. The 4-hour chart window, if you look directly below, suddenly the signals, those bullish signals. Now remember, you've got a strong signal when the lips, that's the green line, has crossed both of the other lines. And often when the candles are far away, like they're becoming here from these lines, we really say that's a good trade open position. So if you're in a position like, for example, here, or here, the probability of you capturing a profit is good because, and if you're in a position that's running whilst those candles stay north of those 3 lines, it suggests that market is strong in your favor in that direction. Certainly not a time to be closing the trade. And therefore we look to then manage that trade by adding an ATR 10, for example, and we kind of double that ATR 10, and then we deduct that from the entry level to tell us where to place our protective stop loss. We don't even really need to do that, even if we're using a 180 phase change of strategy, because as we know, the 180 phase change of strategy has all of those 3 orders connected to it. It knows the entry signal, it knows the stop loss, and of course it knows where to put the take profit. So just looking at a couple of these examples where the jaw is open, suddenly where it's been flat, there's been no signals. Back here to up, look how you get mixed signals. But then with the jaws open, we now have a clear trend direction. It's a bullish trend direction. And then the strategy, notice the 180 phase change. I could be using a trend wave type strategy here as well, because of course that is a trend-based strategy. You'll now start noticing that these strategies, when used in combination with the alligator, show us when we should be trading, when we shouldn't. So let's just flick through a few of these. On the long side, I'm going to look at Aussie dollar now. Again, you can see here is when it's intertwined, which would be way back here where the signals are erratic, up and down, up and down. We want to make sure that those signals are strong and clear. Alligator's going to help us there because they tell us, look, price bars are well above. You can see it's crossed a few days ago. In fact, it's as many as 2 weeks ago, shall we say, in trading terms. The Aussie dollar has clearly opened its mouth. The alligator has. The price is above. And you can see, if we then look at the corresponding 180 phase changer on the same currency pair, on the 4-hour window or even the 1-hour window, you're going to see that those signals, whilst now crossed and moving up, is giving stronger signals. Profit, 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 profit. So we've got some decent trades here consistently. You should then see 180 phase changes kicking out profits consistently with that movement. It's when we've got a disagreement, when, for example, the alligator is sleeping, when the jaws are closed, that's when we're going to get mixed signals thrown up on our strategy charts of our lower time frames, the 4-hour and the 1-hour, because of course you haven't got the jaws open from that higher time frame. So really, really simple, effective and clever strategy. If you could delete half of your losing trades, you would find that your trading account looks considerably better than it currently does. You'll find this strategy will help you do that, or should I say this indicator will help you do that. What it's going to do is just going to remove those false trades, those ones you shouldn't have been placing, which were trend-based strategies on ranging markets. So let's have a look at a few more. So let's look at the euro dollar now. Again, same system. You can see the jaws are open, and now you can look from the jaws being open on the daily over the last, you can see clear phase 1, phase 2 patterns here, but on that phase 1 resumption on the euro dollar, just look at the number of phase changes that have kicked in. 1, 2, 3, 4, 5, 6 trades out of 6, all profitable. Why? Because we're using the combination of the alligator to tell us it's a trending market condition. We're using a strong back-tested trading strategy based on trend. Again, it's the 180 phase change we're looking at here. But we're perfecting this because we're getting ourselves away from trades where the alligator's jaws are closed. If we do that, we know in ranging market conditions, we aren't going to make money. Now let's flip it on the other side and look at, of course, we can use it so we know that when price is below the alligator, that is a bearish condition. We know that when the lips, that's the green line, is crossed back down through both of the other lines, that is a strong bearish signal. So let's take a flip at that for a second. Let's look at, for example, the Euro Aussie. So look, so now I'm looking at a bearish version of the alligator. We can see here on the Euro Aussie, okay, just opened up that mouth, and we can see that corresponds exactly with the 180 phase changes that are being called correctly and are allowing us to get in and make a profit. You can see that nice phase 1 movement of the Euro Aussie is completely consistent with those jaws opening up. So ensuring we look at this to keep us away from ranging markets and make sure we're focused on using trend strategies in a trading market is going to be powerful. Remember, we use the alligator on a higher time frame, and then we enter our trades on a lower time frame. So if you're trading a 180 phase changer, you're looking at a 4-hour chart, you're looking at a 1-hour chart, and you're potentially looking at a daily chart, very similar for the trend wave too. But your upfront higher time frame, if you're on a daily chart, you're looking weekly. If you're looking at hourly, which is 4-hour, 1-hour, you're looking at the daily chart. Best configuration for me, daily chart tells me exactly what that major market condition is, and therefore that is the market frame of reference I'm going to be applying my alligator. And then I'm going to be using 180 phase changes, trend waves, and they will tell me when to enter the trade or when to enter the trade, because I'll know already the jaws are open and I'll know that we are trending and we are not moving sideways. Take note of the long-term trends to increase a better risk to reward ratio. And don't forget, always we use that 200 moving average on our chart to tell us, is this market uptrending or downtrending? So let's have a look at a couple more here. The Euro Aussie, you can see, is consistent. Mouth is just opening on the daily, which corresponds to many of those 4-hour lines, which you can see they've started kicking in here. So these are smart trades. This one being placed here, you can see it's nearly hit its profit target. When the jaws are open and the strategy matches in the lower time frame, you're going to see the stars start to align for you. And for that, I think you're going to find this to be a really important session to add to your trading arsenal as we now go into decent or better volatility and more trending market conditions. Let's look at the sterling Aussie as another example of a bearish movement. You can see here, look, the jaws have been open some time. If I go back here, they were opened here. If you notice. So back here in days, it's been open for some time, and just look at the impact on that 4-hour chart. I mean, if you look, this is a trade 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 trades out of 11, notwithstanding maybe one in the middle there might have got pinged, but you're looking at maybe 10 trades or 11 trades out of 11 are profitable by using this simple alligator strategy combined with a lower time frame trading strategy applied, and that's a 4-hour and 1-hour chart. So there you have it, the alligator indicator, one you may not have used in the past, one you can now see is critical in helping you understand whether you're in a trend or not. Remember, 70% of the time, markets are not trending, they're ranging. So the identification of that mouth opening and getting into those strategies on the lower time frame whilst the mouth is just opening. Remember, the beginning of that opening of the mouth is the best place to be placing your trade. So it's a real identification of the market condition tool, and that is critical. Okay, if you like this video, don't forget to hit like. If you have any comments about what I've talked about here with the alligator, stick them in the comment field. And if you haven't subscribed to this channel already, get yourself on the subscription list. And remember, like I said earlier, you can get a 7-day free trial of Smart Charts by clicking the link in the description below and get all the inbuilt training on me free of charge. I'm not exactly sure how much longer we're going to be running this free trial for. It is coming to an end, I can promise you that. So if you haven't taken advantage of it, take advantage of it whilst you still can. Now, I just want to say thanks to Bob, the alligator, here for joining us in the trading den, and I look forward to seeing you next time. When the lips, the green, have crossed, can't get my words out today, and get all the the green is close.
When it comes to new traders, my general advice has always been to keep it simple, learn some risk management rules, basic indicators, start out small, but do people listen? Nope. Look, I get it, I really do. You're suddenly thrust into this really exciting world of sexy looking software with hundreds of indicators. It's exciting, it's new, and they're all saying, ooh, trade me. I won't tell if you won't. And all the while, there's me, only talking about a handful of the simplest ones, and it must be boring. But let me tell you something. This is an instinct you're going to have to learn to control, because there are literally thousands of indicators out there. In fact, let's try an experiment right now. Open a web page, go to google.com. In the search field, type in Forex indicators, hit return, and you'll quickly be pulled into a deep, never-ending vortex of confusion. It truly is a jungle out there, and you can get lost very easily. I can promise you, you're better off perfecting some simpler concepts before you jump headfirst into the black hole of indicators. But since it's been requested multiple times in the comments, and the fact I'm not your dad, today I'm going to be talking about one of the indicators that you have no doubt hovered your cursor over in a moment of curiosity, and it's called the Ichimoku Cloud, and that's coming up right here, right now. Welcome back to the Trading Den. I'm your host, Greg Secker, and we have just passed 47,000 subscribers. So I want to thank each and every one of you for your valuable contribution. Today, we are talking about the Ichimoku Cloud. Let's do this. First things first, if you're a Smart Charts user, you're going to find the Ichimoku Cloud by clicking on the indicators icon here. And then you'll see it in the list, roughly halfway down. Here it is. Click on it once to apply it to any chart, and then this monstrosity will appear. This is so ugly. I mean, what is that? That really is a face only a mother could love, isn't it? Okay, let me level with you here. Up to about a week ago, Ichimoku was something I'd learned about in the distant past. And when I say distant past, this is when I was trading on floors out in Australasia. More recently, I've seen it in the Smart Charts indicators list, and of course it rang a bell. but I just ignored it for the most part. I don't think it's something that's really ever resonated with me for some unknown reason. But then my content man said, Greg, we have to do a video about Ichimoku. Greg, everyone wants to know about Ichimoku. And I said, all right, fine. I opened up a new account. I started playing with it for myself again. Yeah, it was kind of neat. I strategized a little. I placed a few trades. And then this happened. Yeah, crazy, right? So let's show you how this indicator works. Ichimoku Cloud is a system of indicators and there are 4 main parts to it. The first main part is these highlighted areas here, known as the Kumo Cloud. Yeah, cute name. Still ugly though. For the rest of the video, I'll be referring to this as the cloud. The second part of the indicator is this line here, known as the Kijun Sen. The third part is this line here, known as the Tenkan Sen. And the final part is the Chiku Span, which is this line here. Let's go through each part one by one. The cloud itself is the space between these 2 lines, which are known as the Senku Span A and the Senku Span B. We're not concerned with the lines themselves, they're not important. It's the space between them that is of interest to us. So let's bin the lines for the sake of this demonstration and to make life a little simpler for my animation team. Here's a few basic rules. When price is above the cloud, you may only take long trades. When price is below the cloud, you may only take short trades. When the price is inside the cloud, don't take any trades. Do people listen though? Nope. If you can't stop yourself taking a long or short trade when price is inside the cloud, or if someone is pointing a gun to your head, at the very least, use half the risk you normally would. The other 2 parts are the Kijun Sen and the Tenkan Sen lines. These more or less act like moving averages, but they are calculated differently. The Kijun Sen is the slower moving average, the Tenkan Sen is the faster. When the Tenkan crosses the Kijun upwards, that's a long trading signal. When the Tenkan crosses the Kijun downwards, that's a short trading signal. Remember though, the cloud acts as a filter. Even with valid crossover signals, you must respect the cloud. Long trades are not allowed unless price is over the cloud, and short trades are not allowed unless price is under or below the cloud. This rule will reduce the number of trades you can actually take, but the beauty of this is that it forces you to be disciplined, which, if you remember, is one of the hallmarks of a successful self-directed trader. Last but not least is the Chiku Span. Some would say this is the wild child of the bunch, but the Chiku Span is very easy to figure out. Imagine a chart leaving a breadcrumb line of closed prices 26 bars behind the current one. In fact, if you could pick up this line and move it across by 26 bars, it would fit exactly with the closed prices of all the recent bars, like this. Let's put it back where it belongs for now and note that it always ends at the closed price of the most recent bar, except that it sits 26 bars behind. The idea would be to look for a trade entry first, respecting the cloud of course, and then look back to see if the Chiku allows it. If you had a buy signal at a point where the Kijun and the Tenkan cross like this, and then you check the Chiku Span and found it was above price action, this would mean the trade was allowed. This is because the trend is deemed to be upwards when the Chiku is above the price action and downwards when it is below the price action. And then how we use the Chiku as an exit signal, I'm going to go into a little later when I show you some live examples. Now, if you like that explanation of how the Ichimoku Cloud works, I suggest you click the link in the description below and get yourself a free 7-day trial of Smart Charts, and I'll tell you why. Included with the trial is several hours worth of the highest quality trader education material on the planet. There are modules that show indicators and strategies in a simple, easy to understand format like you've just seen, and it's all rendered in glorious 3D. It took a team of animators 2 years to create, and I can testify that there was quite literally smoke coming out of their ears when they finished. And you can watch it all for free as a gift for being a subscriber to this channel. So now you have a basic grasp of how this indicator works. Let's fire up smart charts and take it for a spin. If you look at how I've set the screen up, and if you look at my screen layout, if I click on that, you'll see that I've picked this screen layout where we basically have two screens which are not vertical, they're horizontal, one on top of the other. The top screen, as always, is the daily chart, which is always daily chart with the 50, which is the quarter of the year, on the 200. Remember, there's 200 or approximately 200 trading days in the trading year. So we know that when we've got the price above the 200, you can see on the Aussie dollar as a classic example, it's now dragging that 50-period moving average above the 200, which of course is our long signal, our sort of long casting signal, from which then we drop into the screen below, which is where we've got the Ichimoku set up. Now I'm just going to show you how you add that. So if you click on indicators, and you'll see I've got Ichimoku Cloud set up on here already. I simply just type in Ichimoku and it brings it up. I've edited it slightly, and I'll tell you what the edit is. It really is a cosmetic alteration. I've taken the Tenkan Sen, and what I've done is I've made it just a little bit lighter blue, purely for recording purposes here today, on a dark blue background that we use on smart charts. I really want that to pop and be contrasting, because it's that correlation, or the correlation of where Tenkan Sen is in relation to Kijun Sen, and when they cross, which is going to give us our long and then our closing position. So obviously on the Aussie US, we are looking for a long position. Then my cloud coloring is Senku A is going to be green for obvious reasons. That's the period of time we should be long. And then my Senku B is red, as a red cloud. Obviously that's when we should be short. It's the size of those clouds which really give us the intensity behind the move. So the bigger the cloud, the more likely the trade is going to work out in that direction. So a big green cloud will expect long positions to work out well. A big red cloud, a Senku B cloud, and would expect short positions to work out well. And then the Chiku indicator, I hope you like my Japanese, is the purple line indicator, and that is the one which tells us the early indication of when to close the trade. So let's put it all together. I've added that onto the chart and show you a few examples where this is good. Now you'll notice if you look at the top right-hand corner of this bottom chart screen here, you'll see I'm looking at the 4 hour, that's the H4. So every bar on this chart is effectively 4 hours in time then. This is not something you want to be looking at on the 30-minute or the 15-minute or the 5-minute. That's just going to be too erratic, and it's basically going to look like a big spaghetti junction on your chart screen. So I want really clear signals. This is ideal for somebody that doesn't have a lot of time to day trade. They want to put positions on, they want clear signals, and they want a good idea of when this trade, or if this trade is going to work out. They want some intensity of that cloud to know, is a long likely to work out, is a short likely to work out, and then some early indication as to when to close that trade and grab those profits. So let's have a look at the Aussie dollar starting out. So you can see, first of all, that blue line, which I've slightly or lightened slightly just for the contrast against that London backdrop in blue that we've got on the chart here, that Tenkan Sen. That Tenkan Sen says as it crosses up through the Kijun Sen, which is that orange line, that would be our, if you wanted to treat this as a trading strategy, it's more of an indicator, let's not forget, but this would be your long signal. So you'd be long here only if the cloud is beneath price action. So this price action here must not be in the cloud. As I said earlier on in this training session today, if the price is within that green cloud, you'd really want to put half of the risk on the table, because you are bringing risk into the trading arena. So this is set up perfectly. Price is outside of the cloud, which means that the big green cloud, as it escalates along and grows in size, gives us certainty that there is power, there is buying pressure. The buyers are winning the war in this market. We've got the entry signal, if you want to use this as an entry signal, and it is a simple entry signal. This really is not for somebody that's in and out within 10 minutes. This is somebody who wants to leave the trade on and check it tomorrow. It's that type of trading strategy. But what you're going to see by doing that, of course, is that it gives you a much larger pip pull than it would jobbing in and out trying to grab 10 or 20 pips. So for those of you that don't have a lot of time to trade during the day, I think Some of you are going to love this. Others of you are going to find this a little complicated. I don't think it's complicated. I think the terminology is complicated purely because I'm British and it's Japanese. But if you can get your head around the terminology and just look at what it's giving you some nice clear signals here. And for many of you that requested this on the channel, this is how I use it, and I have a team on our trading floors around the world use it. And it's in these trending market conditions, you can get some really fabulous outlooks here. So let me show you what that means. It means, first of all, that Tenkan Sen is giving you the long signal through the orange line, which is the Kijun Sen. So you would be effectively long here as long as price, this is price, above the green cloud. Now, as the green cloud grows in size and volume and price is further away from the green cloud, we're still long. So you're in here for many hours, sometimes even many days. That's how long this can last. I really do recommend you start with the 4-hour chart first. You can drop down to the 1-hour chart. I would not recommend that. Stay in the 4-hour chart because you're going to get nice clear signals, and we're going for big pip pulls here. You're going to see what this looks like, but this is not pulling 10 or 20 pips. This is pulling much more than that, a much greater range of pips. And then don't forget, of course, your stop is going to be some way away underneath the cloud. So, of course, the maths, if you can imagine, will ensure that your trade size is not gigantic. It's going to be within range to keep your risk at a sensible 2%. I'll show you how you do that in smart charts in a moment, so you understand how to place the trade and how to trade size it. But most importantly, this is your long signal. Price stays above the green cloud as it goes up. Notice the separation of the Tenkan Sen and the Kijun Sen, which means there's a lot of power in this. This has been a reversal. We look up the daily chart here where we had that retracement from that phase 2 back to the phase 1 movement. Lots of pressure building up, cloud starting to grow, separation of line. That means you wouldn't want to close this trade yet. Hang on in there. Many of you have written me in and left comments and suggestions and questions about when do I close my trade? When do I capture my profit? What is the right balance of that seesaw? Well, one of the biggest old adages of all of the trading gurus around the world is that people cut their profits too quickly and they let their losses run. Well, this ensures you don't do that. And for that very reason, we rank it here on the channel as a very useful indicator because it tells us, is there strength? Is there real strength behind this move? And when is that strength coming to an end? So if we track this across, we can see the blue through the orange line here. That's that Tenkan Sen through the Kijun Sen. We hold it, price moves up. You can see the separation of those lines. And here's the interesting part. There's 2 exits on this trade. Now, I want to really draw your attention to them. The first exit, and this will be one that many of you on this channel will want to go for, is when this Chiku line, the little cheeky Chiku line, the purple Chiku line actually touches price. That could be your first exit. Now, you could ignore the Chiku line and say, well, actually, I'm not going to exit so early. I want to hang in longer. And in fact, I'll take my profits on the table when the Tenkan Sen, that's that blue line, I keep using these terminologies, and the Kijun Sen cross again, which is kind of around here. Let me show you the difference, the pros and the cons of both. If we take out our drawing tools, let's grab that, and we go down to the measure, and I want to do time and price range, and I'm going to take it from where we would have, let's say, entered the position based off the crossing of those original Tenkan Sen and Kijun Sen lines. So that would be here. And if I then move this up to when the Chiku line takes us off the table. Now, look, there's a pro and a con here. The pro is you're getting a relatively quick profit. Let's just take a quick look here. You're getting 438 pips, which is not insignificant in a space of 47 hours. So let's call that 48 hours. In a couple of days, you're pulling 200 pips a day. That's pretty impressive. So it would be an entry here, an exit here, and grabbing 400 pips. So clearly, it's a very strong move that we're looking at. And that's just happened in the last couple of days here this week in the UK. Or anywhere in the world for that matter. This is the Aussie dollar. We're trading from the UK. Of course, you can trade from anywhere. But that would be the first exit. Now, if we decided actually I'm going to ignore the Chiku line. In fact, we could even remove the Chiku line from this so it doesn't distract us. I think users of my channel, and I hope I'm talking to you personally, I hope that we describe things in such a way whereby you can use other indicators. Clearly, I don't want a big dog's dinner all over the chart. I want to keep things as clear as possible, and clarity is better. However, I kind of like the way the Chiku line gives you that early indication. Now, 2 other things to be aware of. If we didn't use the Chiku line for the exit and we said, actually, I'm just going to enter on the crossing of the lines here, which is that Tenkan Sen and the Kijun Sen, and then when they cross back onto each other, which kind of puts us in this territory here, you are similar kind of profits, maybe 473 pips. So The Chiku is kind of, yes, it's getting you out early, but just don't forget, the moment you come out and you crystallize that profit, risk has been eliminated. So what the Chiku is allowing you to do is maybe you're not going to get the full pip pull that you would get if you waited for the Tenkan Sen and the Kitchen Sen to cross again. But, whilst that trade, don't forget, anytime a trade is open, there is risk on the table, and that's your risk, that's monetary risk. So from a trader's perspective, I always think, when we call ourselves traders, we really are. We're either gamblers or we're risk managers. And traders are risk managers. And gamblers are people who don't really factor in risk too much. That Chiku line is helping you take the early profit. In actual fact, when you consider the amount of additional time you're having to stay in this trade to benefit from the Tenkan Sen crossing down through the Kitchen Sen again, you're paying brokerage fees, you're keeping the trade open for longer, there's more risk on the table. A sensible, self-directed professional trader says there's a decent profit. If the Chiku line is giving me the exit, let's get the money off the table, let's crystallize it, let's bank it, and then let's move on to another trade. I much prefer that approach. So in my opinion, keep the Chiku line on here because you're getting a profit quicker. There's not really much in it. And if you factor in as an intelligent individual, the time that you're leaving yourself exposed to the market, there's intrinsic risk there. And of course, there's financial risk. Of course, you're paying brokerage fees, you're paying swap fees, you're paying overnight financing fees. And if you factor that all in, is it worth the additional 20 pips in this example? My answer to that would be not really. Just notice the cloud always is ahead of price by 26 bars. So we know that price is the cloud here is telling us there is still strength here. So you've got to weigh up your options here. Do I continue to trust the cloud? And the cloud says things look great, because a cloud that's big like this can suddenly become quite small if there's a big market reaction. I'm all about, if you can make 400 pips in a couple of days, grab that money. Use that Chiku line and get your cash off the table, bank the cash, and then go on to something else. Leaving yourself open and exposed, I think, is not the most intelligent idea. But this certainly indicates that there is further upside potential. You have to understand this has to factor into your trading plan, and your trading plan should drive this. If your trading plan says, look, I'm going to use this tool to grab profits, but my maximum trade length is around 2 to 3 days based on current market volatility and current market volumes and movement, then that's what you're going to do. Let's look at the euro dollar now. Same sort of thing, as you can see. Very easy to show you the Ichimoku cloud this week because of clearly we've got some nice cloud formations. You can place any trade and you can leave your take profit way up in the sky. What you can't leave way up in the sky or way down in the depths of hell, of course, is your stop loss. And so let's just talk about that for a second. So let's say I was going to be long at this level. Of course, price is all the way up here right now, but let's just kind of dummy play this a little bit just so you can understand how this would be done. So I would like my stop loss to be underneath the cloud here. So if my stop loss is here, let's say my entry would be here. So you can see, for this position, so I'm taking a long here. I've got my, one sec, folks. There it is. I thought that was a little bit too far down. So I'm taking like a 53. So I'm sitting the other side of the cloud. I've got a 53 pip stop. My take profit would be somewhere like here, but don't remember this. I don't know when the Chiku line is going to hit price. I can never predict that. So I might decide to keep my take profit just well out of the way. All I need to really care about in order to trade size this is the buy entry or the sell entry and the stop loss. The difference between where I get in and where I get out for a loss is my risk. Don't forget that. So in this example, and similar with the Aussie, if I'd have listened to what the system told me, what the Chiku line told me, I'm really risking, say 64, maybe 70 pips of risk, okay? In order to capture, maybe as it says here, 404. So the risk reward here is certainly well in our favor. But just remember, the larger the risk that you take from the entry price to the stop loss, the greater that risk. Of course, that must impact your trade size. Remember, trade size is automatically calculated for you on smart charts. You don't need to get your pencil and pen out for that. Certainly, you can see as I move those lines around, as I move my risk and entry lines around, it updates and changes everything on the right-hand side. If you've got smart charts set up with your trade ticket appearing on the right-hand side, you can change that in settings and have it appear on the left-hand side if you want. I like it on the right-hand side so I can focus on the chart first. So wherever I move those lines around, it will adjust that, which means if you're somebody that's out there that's watching this channel and you aren't using smart charts, First of all, you must be the craziest individual on earth watching this fabulous software do all the work for you and then sit there on bloody MetaTrader. You literally must be blowing your brains out. But if you are blowing your brains out and you are someone that is starting out and you haven't got the funds to use an intelligent system like this, then you need to understand the formula of how to calculate your trade risk. Basically, the greater the risk on the trade, the smaller the trade size. That should obviously make sense. So, if you're trading a $10,000 account or a dummy or a demo $10,000 account, as some of you are as you're starting out, you want to remember that you don't want to be risking more than 2% on any one trade. Well, 2% of $10,000 is $200. You would take that $200, you would divide that by the trade risk. If the trade risk in this instance is 50 pips, let's say, for example, then 50 goes into 200 4 times. Your trade size would be £4 per point, or $4 a point if you're trading in any other parts of the world. So that's how you would calculate the trade size. That math, I think, is ridiculous to sit and have to work all through when a system as intelligent as this can do the work for you. So remember that with this Ichimoku cloud on the 4-hour chart, you are factoring in more volatility. You are keeping that stock outside that cloud, which of course, with that cloud growing in size, it means the risk is going to be a little bit bigger, which means, of course, to keep risk, importantly, at 2%, the pounds per point, the trade size, the contracts, the lots have to be smaller to account and make sure, therefore, that we're only keeping our risk and we're not exposing ourselves to more than 2% risk on that $10,000 account. Of course, at £4 a point, you would be, you'd have made £1,600 on your trading account. 400 times 4 is, of course, £1,600, which, of course, on a $10,000 account, this trade alone, by risking 2%, you'd have made 16% on your trading account, which I think by anybody's scale is a good return on investment of your time. So that is how we use it. Let's just kill that because I'm not going to place that trade. That's already happened. I'm just going to show you a couple more. So sterling, same picture again. Now, interesting, you can notice here, right, what is the problem with the sterling cross here? The problem here is you wouldn't enter this trade. I wonder if anyone can figure out why that is. Well, I'll tell you as you're probably entering comments, and please do enter comments as I go throughout these throughout these examples. Look, you are very much in the Senku B cloud, which is the red, which of course is the sell cloud, which is the one which says, look, and you can see this is that turning point where it moves from one to the other. So whilst you'll have had your cross in the red, we don't place trades when the price bars are in the clouds anyway, but of course you would never go long while price bars are sat in a red cloud. So sterling, you would not have caught on the Ichimoku cloud strategy. You would have caught the Aussie, absolutely. You would have caught the euro dollar. And looking just at the Kiwi now, that same thing, the Tenkan Sen cross with the Kijun Sen, this happens just as the cloud is forming. Now look, you don't have to buy when the lines cross. So just be aware of that. If they've crossed and you're in the red zone and now they're starting to separate and that green cloud is forming, you can go long. And there's nothing that says when the lines cross, that's when you have to press the button. That's ridiculous. The strategy here is if the line's crossed or is crossing or has just crossed and those lines are separating and that cloud is building up, you can enter that position. Remember, your stop is below here, below the cloud. That's giving you a really serious safety net. Some of you may wish to be more aggressive. I'm not interested in you guys being aggressive. I want you guys to be safe. So I think a stop outside the cloud is safety first. If you want to be closer to price action and then do an analysis on, okay, well, where really is support, which in this market you could see it would be around here, you could place your stop there. It depends on your level of aggression and it depends on your level of risk appetite. So they're the long trades. Let's have a quick look at a short position, which of course is the dollar Swiss. Let's bring that up. And you'll see dollar Swiss here. Okay, how and when do you enter this? Now, we don't enter. Remember, when price is in the cloud, not a time to enter this position. We want to enter this when, of course, the Tenkan Sen has broken down through the Kijun Sen. That puts us in one of two areas. One would be here. Another one would be here. Remember, we're using the Chiku when it comes back, and the Chiku right now is here in line with current price action. When that touches the price, as it hits those price bars, that would be your early exit. So you could be short here, running this position. Again, stop. Now, you can do two types of stop. One could be above the range, so above this resistance range here would be a sensible place to put a stop. But again, keeping the more risk-averse approach would mean placing the stop above the cloud. Remember, the cloud is now forming and getting bigger. It does reduce the trade size, which means you're going to get a smaller profit, but of course it keeps you safe, and I'm much more interested in you doing that. As much as I've enjoyed expanding my knowledge on this indicator, I'm sorry to say I think that this love affair is coming to an end. I always say that you should use strategies and indicators that resonate with you, and that means you personally. Each one of us thinks in a unique way. Our brains are wired differently, and this indicator is just not something I see myself using regularly going forward. Those of you who know me, I'm a pivot trader. I love pivots. I love fib pivots. I love fib levels. And of course, you know I love the 180 phase changer. I love the trend wave. I developed them years ago in concert with a group of traders, and that is in my core. So it's something I'm not going to jump away from. That all said, I made this video for you guys because you requested it. So feel free to keep sending in your requests, and my team and I will do what we can for you. Okay guys, if you like this video, don't forget to hit like. If you're not a subscriber already, get yourself on the subscription list. You can do that by hitting subscribe. And if you have any comments about this video or any other videos, please do put them in the comment fields. And remember, like I said earlier, you can get yourself right now a 7-day free trial of Smart Charts by clicking the link in the description below and get all the inbuilt training on me free of charge. That's my gift to you. Until next time, I look forward to seeing you